Sounds like they're having trouble either. There we go. There's John coming on. I don't know how they're connecting this to the rest of the group. Hey, John.
Council members, can you hear us?
Yes.
Yes.
Yes, thank you.
Good morning. Let's call this meeting to order. Can you please take the roll?
Land Commissioner Stephanie Garcia Richard. Treasurer Laura Montoya. DFA Secretary Wayne Probst.
Present.
Nick Teas. Present. Catherine Allen.
Present.
John Bingaman. I think you're on mute, John.
Present.
Kelly O'Donnell. Alan Sanchez.
Present.
Kurt Summer. Present. That's 7 that we have here. That's a quorum.
Wonderful. Let's go ahead and start off with approval of the agenda. Did everyone get a moment to take a look at it? If so, I'd entertain a motion.
I move we approve the agenda as proposed.
We have a motion from Kurt Summers, second from Nick Teas. Call the roll, please, unless there's discussion.
Commissioner Stephanie Garcia Richard. Treasurer Laura Montoya.
Yes.
DFA Secretary Wayne Probst.
Yes.
Nick Teas.
Yes.
Catherine Allen,
Yes,
John Bingaman,
Yes.
Kelly O'Donnell, Alan Sanchez,
Yes.
Kurt Summer.
Yes.
7 in the affirmative, motion passes.
Wonderful. Let's go on to approval of the SIC minutes. If everyone had a moment to review them, I will entertain a motion.
I move we approve the minutes as presented. Second.
Is there any discussion? Seeing none, please call the roll.
Treasurer Laura Montoya,
Yes.
DFA Secretary Wayne Props,
Yes.
Nick Tess,
Yes.
Catherine Allen,
yes,
John Bingaman,
Yes.
Alan Sanchez,
Yes.
Kurt Summer.
Yes.
That's 7 in the affirmative, motion passes.
Wonderful. Let's move on to agenda item number 2 and hear from John Clark. Yay.
Thank you, Madam Chair and members of the council. So I want to quickly give an update on the legislative session. Last month, I mentioned that there were about 40 bills that would have impacted us, including about a dozen or more that would have created new funds for SIC. It's wonderful the legislature has seen the value of creating trust funds and setting aside some excess surpluses today to create ongoing revenue sources over time. But I also mentioned last month that it would be exceedingly difficult for us to actually be able to manage a dozen new funds if we were to get them all at once. We're managing 12 now. Luckily, 3 of them passed. That's a manageable level. That's the same number of new funds we got last year. So this will take us to officially 15, although technically one of the funds isn't funded. There was no money put into it. So the fund technically exists, but we'll only be managing 14 for the time being. All of the other bills that would have impacted us, either no money was put into the funds and so the bills died for that reason, or there was opposition to the structure of the bill, or the bills just didn't move through committees quickly enough. The ones that did pass are Senate Bill 1, which creates a behavioral health program and behavioral health trust fund. So we get the trust fund, and the legislature appropriated $100 million into that. And then Senate Bill 88 creates a Medicaid trust fund, and that one, there's no money being put into it immediately, but the way that's going to work is every year when there's an excess of agency reversions that would ordinarily go back to the general fund, above a specified level, instead of going to the general fund, that'll get sent to this fund until the Medicaid trust fund reaches $2 billion. Once it reaches $2 billion, then the annual agency reversions just go back to the general fund as normal. It's impossible to estimate each year, or it's impossible to estimate well each year how much agency reversions will be, so we don't quite know what to expect, but likely something in the order of tens of millions, perhaps up to $100 million each year coming into the Medicaid trust fund. And this is intended to be a state matching fund to match federal dollars for Medicaid. And then the third one that passed that creates a fund for us is House Bill 113. It's the Animal Welfare Program Fund and Animal Welfare Trust Fund. The legislature appropriated money to the program fund, a relatively small amount, but didn't put any money in the trust fund. Because of other priorities, they didn't have enough money to put into the trust fund at this point, but it's there in case the legislature wants to use it at some point down the road. With a lot of help from various other agencies and council members and advocates, we were able to help fix some language that was in some bills this year. We made significant progress in working with bill drafters in the last interim on trying to make sure that when they draft bills related to SIC, especially if they're going to create a new fund for us, that they use a very specified platform of language. Mostly that worked. There were some bills that were drafted that were just really problematic in how they were structured, and luckily we were able to get the most egregious errors fixed before any of those bills passed. We were also able, with some help, to get certain bills from passing, including one that we had noted was likely unconstitutional. It would have immediately ended our New Mexico program, but also the way it was structured, it likely would have required us, if we weren't to fight it in court on unconstitutionality grounds, would have required us to either sell at a loss existing positions in New Mexico investments, or go back on binding legal agreements that we've already made in commitments to the New Mexico program. So the bill was just structured badly, so glad that that did not pass. Really want to thank council members and advocates out there who helped us with that bill and with various others. We will have 15 funds. As I said, 14 of them actually will have money in them moving forward. And overall, legislators tended to voice significant support for SIC and for what we're doing. There were a few comments made along the way that showed that clearly there's some need for some ongoing education to explain better to the legislature what we're doing, why, how we're doing it. And as always, keeping in mind that it's important to frequently reiterate when funds make sense for the treasurer to manage and when funds make sense for SIC to manage. The treasurer and I were very active in dealing with that during the session as well. And with that, Madam Chair, I'm happy to answer any questions.
Does the council have any questions? I would just make a few comments. It was a lot of collaborative teamwork. I'm sure not just with my agency, but with other agencies. This session definitely showed teamwork makes the dream work. The analysis that SIC did on all of the bills was amazing. It was detailed, it was specific, it was clear. And I'm not sure how many analysis you all did, but I think it was over 40. Is that correct?
Madam Chair, yes.
I know our office had quite a few analysis, but sometimes SIC was ahead of us on that. And so it was really good to see the perspective of the two. I will say there's a great partnership with DFA, so I want to thank Secretary Probst as well, because that Senate Bill 88 originally started with trying to get interest earned off of the Treasurer's General Fund, and all of the experts in investments and in finance helped change that decision to make it something that's more realistic. Senate Bill 88 came from the idea of the potential of Medicaid cuts in New Mexico, and for those who are not aware, New Mexico has the #1 dollar amount for Medicaid in the United States. About 33 or 38% of all New Mexicans are on Medicaid. 80% of our babies are born into Medicaid. So New Mexico will be impacted the most by any type of Medicaid cuts. So the legislature and the governor, along with all the different agencies working on this to get this accomplished and up to the governor's office, was a huge task, and it's very preventative of what could potentially happen to a lot of our New Mexicans. So only question I have for you, Mr. Clark, is House Bill 113 on that welfare fund. Do you know the dollar amount that was attached?
Madam Chair, I believe they appropriated $5 million to the program fund. Yes.
And will we be doing the asset allocation for the money that comes over from SB1, the behavioral health program?
Madam Chair, yes, we'll be doing the asset allocation for that and for the Medicaid Trust Fund.
Okay. If no one has anything else, we'll move on to Mr. Vin Smith.
Thank you, Madam Chair. Good morning, everyone. Good to see you all.
Oh, I'm sorry. I
I
apologize.
just,
I can't hear her.
Madam Chair, just comment, a great job both in the analysis and in getting the new funds and also in preventing the potential bill against New Mexico investments. So thank you all for the great work.
Thank you, Member Ellen, for bringing that up. It was a really good team effort with SIC and with SBIC, speaking to analysts and legislators to make sure that the New Mexico Grow stayed vibrant and didn't get impacted. So thank you for bringing that up. Mr. Vin Smith.
Thanks, Madam Chair. Well, as you all noticed, just last month, we had a correction in the equity markets. The S&P actually hit correction territory right at -10%. NASDAQ was hit a little bit harder, but didn't quite get to bear market territory, which would have been -20% on that index or any index. But we're back into a small rebound today. We'll be doing up the rebalance sheets, in fact, this afternoon to kind of see impacts on the portfolio and if we need to move any money around. Looks like we've got to raise a little bit of liquidity for the private equity portfolio, thanks to capital draws there. But we're fully liquid in the other pools, it looks like, and if we have to buy any securities, it'd probably be in the international equity markets, just guessing from looking at the preliminary rebalance. We're just not in a big hurry here in the US. Valuations are still pretty high. One of the measures we look at is the earnings ratio of the equity market. So it's just the inverse of the PE. So instead of price over earnings, it's earnings over price. So we take that ratio and we add the 10-year bond yield. When we do that at today's prices and look back historically, we're still about one standard deviation below the average back to the 1990s. So valuations are still pretty high in the equity market relative to history. So I don't think we're in a big rush to do a lot there unless our rebalance sheets tell us we need to. Yeah, I think that was it on the correction. So far, the year's playing out as we expected. I was just looking at the notes that I used at our January meeting. We were expecting a little bit of volatility in the markets. We got that. We were expecting a good economy. We've had that. Economists are pulling back on estimates, particularly here in the U.S. and just a little bit in Asia. Europe estimates are actually coming up a little bit for economic growth. A lot of the cuts that analysts are doing for the U.S. has to do with tariffs. That's pretty tough. It's hard to gauge how they'll work, or how they'll impact the economy. So I think everyone's just being conservative and pulling back a little bit, but still good growth. The economists we follow the closest are still around 2% for here in the U.S. So I think we still have a good economy to underpin the markets. We're expecting high geopolitical risks. That's playing out. And we thought we'd get there was the potential for some social unrest. I think we're seeing that a little more targeted than broad, but I think we're seeing a little bit of that. So we got economy headed in the direction we thought, sort of the environment headed in the direction that we thought. Markets are responding. I was really happy to see that Secretary Bessemer, the Treasury Secretary, stayed pretty quiet during this correction. Jay Powell at the Fed stayed pretty quiet. So it's encouraging to see that the Fed at least is not going to come rushing in at first sniffle that the markets have. That's been the case since about 2008, 2009 for sure, and less of that goes a long way. In terms of portfolio management, I mentioned good capital calls in private equity. We're seeing that across the board. We're a little bit ahead of where we normally are at this time of the year. It's usually a little bit slower in the early spring, but we're a little bit ahead. A lot of that has to do with capital calls from private equity portfolios, so that's a good thing to see. Last on staffing, I'm very happy to say that we've got a new strategist, Craig Johnson, starting on March 31st. So we're happy to get Craig aboard. He's an experienced finance person, and I think it will really help the team out. Madam Chair, that's all I have.
Council, does anyone have any comments, questions? I'll start off online. Member Allen?
Just a couple of questions. One is concerns about going into a recession, in particular because of the number of layoffs of people, the tariffs possibly causing inflation. So what's your view on the potential for inflation because of the tariffs and a recession because of the number of layoffs and the cutbacks by a number of corporations in spending or hiring?
So on the inflation front, some of the things that really drive inflation are energy prices, and that's down. Housing costs, and that's sort of flat. So a couple of the big drivers just aren't pushing inflation ahead. There is a linkage between tariffs and price increases, inflation here in our country and any country really, but it's not perfect it's not perfectly direct. So if we raise tariffs on a country, it may or may not have a direct effect on inflation. So really, we just have to wait and see. Economists do think it's going to slow the economy. They pulled back maybe a half a percentage point. Some of the bigger ones on what they think U.S. growth will be. And a couple of them have pushed up inflation rates, but only by 1/10 or maybe 2/10. That was about the biggest I've seen. On the potential for a recession, I say this so often, you guys will recognize it, but we just haven't had a proper recession since 2008, 2009. And it's just hard to believe the economy has gone this long without a proper recession. So we had a really big slowdown in 2015. We technically hit a recession in 2018, but it was just for 2 quarters, and they were barely below zero. We did have a recession, but it was 2 months over the COVID timeframe. So the economy just has not gone through a proper recession, and so I think just about every year we have to expect, that we potentially could enter one.
Member Allen, you have the floor. Member Allen, you have the floor. Did you have any other questions?
No, that's it. I just said thank you. Mhm.
Okay. Member Bingaman, did you have something?
No, Madam Chair, thank you.
Gentlemen, do you have any comments, questions, or concerns? I wanted to hit on that just a little bit more, Vince, because you were around for 08, 09 too. What do you see from then that you see now that we could either be preventative? I mean, a lot of your comments are, we already sort of knew this was coming and you've been preparing, but for the rest of us, what does some of that preparation look like? What do we as council members need to be, or even elected officials, need to be looking at to be as preventative as possible in this matter?
Sure. So the first thing that's happening today, we're going to review our long-term capital market assumptions. So that'll give you a good idea of what sort of earnings we can get from the markets on a longer-term basis. And we'll review the impacts on each of the portfolios, so you'll be able to review the asset allocations of those portfolios. I think a lot of what would keep us safe relatively safe in a big downturn in the markets is just simply the excess capital that we have that's mostly sitting in bonds and cash. So that would be really protective against big losses in the portfolio. So a lot of that's just happened because of the cash flow. We wouldn't be in this position without that cash flow. And I think third, just the general construction of our portfolio, the excess capital that we have. We're a lot more into the private markets and a lot more in assets like real estate and our real return assets, which really flow a lot of cash. And that really helps when you get a downturn in the equity markets, is having an asset that flows a lot of cash.
So, second question. You mentioned tariffs a little bit. I know state treasurers have been talking about tariffs quite a bit. New Mexico, number one provider for Mexican tariffs for us. Equipment that we use for oil and gas, which we're number 2 in oil and gas. Medical equipment for our healthcare industry. Uranium for our military and our labs. And then, Member Ellen mentioned the federal employees, the lack of or I guess the increase in a lot of change with a lot of federal employees. New Mexico has a lot of federal employees, military, and now we see that education is going to be shifted. I know that you guys have mentioned we don't worry about the noise at the beginning. It's more the long-term effects. We have a lot of cash on hand, so when things are good for us to invest it in, we have that opportunity. But a lot of these are going to impact New Mexicans, which then means, for example, the legislature will have a special session, not just on public safety, but on how we compensate a lot of these employees who are being devastated. So from that perspective, I know we have the cash for that emergency as well. But when we're looking at how we need to decide long-term on these investment strategies, we don't want to be reactive because this is short-term. But what's your thoughts on what we should be thinking about? I mean, I know, for example, in my mind, the DEI does matter, even more so than before, because those industries that we might be invested in that are now going to be impacted because people are not going to be going to either work there or to shop there is going to impact whatever we might be invested in. Same thing is happening with anything that Elon Musk holds. Do we hold any of that stuff? And then it's, the other end of it is what New Mexicans value versus what we're investing in, and are we aligned with that? Because if we're not investing in our people's interest in the long term, how does that impact? So I know it's a lot, but what's your thoughts on it?
Well, I guess, the first thought is really, we're very well diversified in the portfolio. So we've got assets overseas, we have assets across, 7 different asset classes. Each of those asset classes are very well diversified. In fact, you're gonna hear today, a structure study from the, real asset portfolio. And that's how we, those are really important in how we approach those markets. So you'll get an idea of how a better idea of how we're investing there, or how we expect to invest in that real return area. So really, I think our diversification, helps us out a good bit there. In terms of investing in line with values, I would say that comes from the council. You all direct us through policy to get that in alignment.
Okay, thank you. Member Tell.
Just another question, and I know, we're talking about a whole lot of different things right now, but, there's a lot of information out on adding more trillions of dollars to our national debt. And, I don't know if it's the proper time to talk about that now, or with the presentation that RVK will present here in a little bit. But in terms of cash and cash on hand, a weaker dollar, all of those different dynamics with adding more to the national debt, like what are your thoughts on that, and how do we sort of mitigate and plan around that within our updating our strategies and things within this new environment?
So one of the reasons the economy's been so strong, and well, really, has avoided, serious recession since 2008, 2009 has been the deficit. So we're pushing, federal government now is pushing 6.5% of GDP into the economy through their $2 trillion deficit at present. That's Depression era spending by the Fed. That's when you're in a depression, you spend like that to get out of it, and we're pushing that much horsepower into the economy every year for the last 3 years, and it's been between 3 and 4% of the economy since 2008, 2009, and it's just only gotten bigger from now. In fact, the last time that we ran surpluses was 1990s. So since about the early to mid 90s, we've run deficits since then. And then of course it's piled up to 36 trillion now in total debt. That's over 100% of our GDP. There's plenty of good studies that show once a country gets over about 100% of GDP, it starts dragging on growth. Now we've got the advantage of having, our currency, but the reserve currency anyway, that other countries that these studies look at did not. So we're a little better shape because of that. But you have seen decline. A decline in the U.S. dollar helps us a little bit in the portfolio because it increases the value of our foreign investments. So we not only get the investment return that those investments make, but we get the currency change also. So it's always our hope, and we wrote in our last annual investment plan, in fact, the last two, that we hope the federal government can get their hands around this deficit spending and start pulling that back.
Thank you.
Wonderful, thank you very much. We'll move on to item 2C, Performance Report, January 2025, RVK and Nino Carpenito.
Sorry, I don't think that the middle microphone is work. The other two are not hooked up.
I just wanted to make a few brief comments. So we've been working that we would like 3 months within on it. And in the month ahead, we would expect that.
I'm sorry, we can't hear. One moment.
They're working on it. One moment, please.
Is this better? Oh, wow. So wanted to let the council know that we've been discussing ways of improving performance reporting for the council. And in the months ahead, we think you'll see some meaningful changes in the way that we report performance. And of course, your feedback is a very important part of this process. With that, I'll turn it over to Arby Kuntz.
Good morning. All right. So we've talked about the market. Since this is a January flash, we've had 2 down months in the markets since this, so I'm going to be pretty brief, and the goal is to talk about our long-term capital market assumptions, and we are looking forward to working with Nino and his team and Don on the reports. If we go to page 4, and I don't have it on. If you go maybe 2 pages forward on the performance report to past the market environment. Oh, that would be better. So let's go to page 22 of diligence and look at the performance. Again, this is of January, and I'm going to talk about the performance at the bottom first, looking at land grants and severance tax. Well, 22, one backwards. Yeah, at the bottom. I will say that in our future reporting, there's going to be more focus on net of fees. But on this report, I just want to say for the land grant, if you look at the trailing time periods, short term, there's a slight underperformance for land grant against your benchmark, but that's short term and only 2 basis points. But longer term, beginning with fiscal year and out to 10, the land grant has outperformed its policy benchmark, both on a gross and net of fees basis. Severance tax also trailed its benchmark short term, gross of fees through 5 years. Well, actually, gross and net of fees through 5 years. The severance tax has actually beat its policy index. Longer term, it's trailed on a net of fees basis, but great movement forward on outperformance for both. I want to take a couple of minutes talking about asset allocation because what the discussion is going to be today is long-term capital market assumptions and asset allocation. So on this page, if you look at the right-hand side, you can see the allocation. That target that is much closer to the far right.
One moment. They can't hear you again.
Okay, so is that better? Can you?
Yes.
Okay. So we'll talk a moment about asset allocation. On the right-hand side of this page, you can see the allocations for land grant and severance. Both of these have an interim target allocation that we're using, we'll be discussing in a couple months again, but also showing the long-term target. Staff has moved you closer to your target, just pointing out that where you're overweight is to the public market fixed income and to cash. And that is, again, you have a moving target for your private. As Vince said, you're making headway on getting allocations, or getting money invested, especially on private equity. But when you get so much cash inflows, that you hit a moving target, and you're working hard to get to your target allocation, but it does take time, especially when you have the luxury of actually having money coming in. But to that point, if you look at private equity, as of the end of January, your actual allocation is 9.5%, 9.57. Your interim target is 12, but your long-term target allocation is 15. So you have 5% that you need to build into. Now, that's important, and I want to bring that up because when you're looking at asset allocation today, and we support private equity and private investments, and Jen said they're a great diversifier for you. but the models, we have to be realistic with the asset allocation models. And so private equity is constrained, for example, for the line grant to 50%. And if we didn't constrain it, it would want more, but it's not realistic to believe over a three-year period that you're going to be able to go more than 5% into private equity. So again, the models are private investment, but you can't get it implemented to it. We don't want an unrealistic target for those private buyers. And that is also the same story for severance tax that you can see below with private equity, ex-state, you're 4%, your target is 10. On page 5, we also have an interim target for the tax stabilization fund. Actually, that is, let me see this a little bit. On the top left-hand side, the allocations, you'll see we're showing an interim target, but if you compare the actual asset allocation to the long-term target, you'll see that you're actually at your long-term target for severance or for the tax stabilization fund. So that interim will go away. And then the other interim target is on page 24 at the top left-hand side again. And it's the same story for early childhood as it is for land grant and severance. So you're overweight, your public fixed income and cash, waiting to fund those private investments that you're underweight. Any questions about allocation? Just want to spend a little bit of time about that because we are going to be talking about allocation. We go, a couple other things I wanted to point out. We go to 26 of diligence. This is the calendar year, so this is 1 month. But often the question comes up of why for example, why is tax stabilization, was it return only 0.46 and land grant is 1.56? Just a reminder that tax stabilization and the workforce development have no equity in their portfolio. So that's the difference in the return. And actually, when we look at, we're not at the end of the quarter yet, but those funds perhaps will be better because they have no equities in the portfolio and we've had to follow the market. Quickly on just looking at your deposits on page 30 of the report, just briefly we show the land grant and severance tax. Again, this is a monthly report, so there are no interest returns for private on a monthly report. You can see that the global equity was positive calendar year to date, and this will look much different than the March. Looking at U.S. equity, both U.S. equity and non-U.S. equity were positive for the short term. Non-U.S. equity has been strong outperformance across the board. Public fixed income also outperforming its benchmark. Private markets fixed income still trailing, but you're changing that portfolio and you also have a benchmark change. And then just as a reminder, you do have an overweight cash currently, and if you look at the 1 year return for cash, that's at 5%. So not a bad place to be. And then on the following page, page 31, again, you'll see a lot of zeros here. Again, this is a monthly performance, so we don't have numbers for your private. The only thing we're showing here at the bottom, you see the economically targeted. We are able to show that, and so that's at the bottom of the page. With that, that's a brief summary, and happy to answer questions.
Any questions from council members? We'll start online. No question? Just one question. Can you remind me what the overlay program is?
That's on
Page 11?
I missed the question, I'm sorry.
What is the overlay program?
Oh, sure. So
3.4.
So we've got an account at Parametric that when we want to make allocation shifts in the publicly traded markets, we have the opportunity to do it with them in the derivatives markets rather than move cash. It costs us fees and commissions to say sell stocks and buy bonds, but we can do that almost commission free and almost cost free in the derivative markets. So we occasionally use them to make a smaller trade.
Thank you for pointing that out. This is actually a new page to the flash to show what you have in the.
Wonderful, thank you. If there's nothing further, we'll move on to 3A, Investment Committee Report by Member Bingaman.
Madam Chair, thank you. We had our meeting last week. Thank you for joining us. We did have a quorum also. Member Tejas joined us along with members Ulrich and Roman, our advisory members. After reviewing each of the investment matters, we were able to recommend each of them unanimously to the council today. So that was our meeting, and that's my report.
And Member Bingaman, just so you know, this morning, Member Ronan is in the building with us. So if you could raise your hand and wave to everyone. She has done amazing work with us in the investment committee, and she came to visit us. So just wanted to make sure you knew. Does anyone have any questions for Member Bingaman? Seeing none, we'll move on to B, long-term capital markets assumption. I don't see a nod. Member Bingaman, can you guys hear him? Nod if you.
Yeah, I'm here, but sorry, I'm not presenting 3B, am I?
No, I'm no.
Yes,
No,
you're at.
we were just checking to see if you could hear RVK.
Okay, yeah, no, I wasn't able to hear them. But
Are you
could
able
you
to,
say something?
are you able to pick up audio now for us?
Yes, yep, you're coming through now. Thanks.
Okay. Okay, great.
Thank you.
Thanks again, Madam Chair. Morning, everyone. Today we are quite pleased to present to you our updated capital market assumptions along with the impact to the long-term return expectations for the various funds. It's a thick packet. I'm not intending to go page by page, but I know there's some that like that level of detail, so it's in there for your reference. The way we've structured it this year is to provide you with an executive summary. We can go through that, make some high-level comments, and then we can dig a little deeper, and you all let me know how deep you want to go on some of these things. But hopefully we can tie it all together. If you flip to the introduction slide, which precedes the process flow chart, these are a couple pages back if we could, page 3 of our deck. Yeah, one more back if we could. This is just an introductory page, and as we preach regularly, asset allocation is arguably the most impactful decision that council members and trustees make, certainly in terms of the impact on the long-term return prospects of any program or institutional fund. And so because of that, we spend a great deal of time on it every.
Okay. Yeah, apologies. There now does seem to be an issue with the audio.
For those members online, we're just taking care of some technical issues and getting some batteries into the microphone. Thank you to our amazing IT.
Thank you very
Chris.
much. Are folks able to hear me again?
Yes, they're
Online?
nodding.
Yes, okay,
Thank
nodding,
you.
yes, that's a good sign. Great, I'm not quite sure when I dropped, but I was just emphasizing that we conduct this on an annual basis, but really do the formal asset allocation review every 3 years. And the next time we're due is next year. This is an interim year. So quite important still, just to do a reasonable check and ensure that the portfolios are largely allocated in line with the efficient frontier. And again, even though we do it on a general 3-year cycle, it's not to say that we couldn't do it more often, and we have in the past, either if there's a big market dislocation or an objective for a fund changes or a new fund. So there are plenty of opportunities to reassess along the way. But this is largely a byproduct of the annual process to refine our expectations for the markets on a go-forward basis. Again, these are long-term assumptions. We have no clue what's going to happen next week or next month, but have pretty good certainty in terms of what will happen over longer time periods based on a lot of the things that Vince already mentioned, different valuation metrics across the asset classes and economic indicators that you can look at. So this is an important process. It's memorialized in your investment policy statement. We have some of the excerpts there. And then as part of this great flow chart here on the next page that you see, it really fits in at the very beginning of the decision-making hierarchy or framework. So this is quite impactful and has many downstream effects in terms of what do we think the asset growth will be, that impacts pacing, how many investments, what kind of check sizes do we need? It really flows into everything. And so it's really quite important. Now, when you have a program of this size, but really any institutional program, it tends to be more of a tanker. It's not a speedboat. So changes tend to be more forward-looking. They tend to be more gradual. Certainly not trying to be tactical, any of these things, but we're trying to be very aware of what's happening in the markets and in the economy, and we're trying to nudge the portfolio in the right direction based on the various objectives that these funds have. On page 6, perfect. Yep, you'll see some themes for 2025. And we've tried to highlight them here as part of this executive summary. I think based on the discussions that we've had already and likely just being aware of what's happening in the press, probably not a surprise to anyone that equity expectations on a forward basis are down. Valuations are up. We've had 2 back-to-back 20-25% years that have pushed various valuation metrics. Vince mentioned one, the CAPE ratio or the Shiller ratio is another one that's often referenced, and that is currently in the 98th percentile going back 100 years. So it's not to say that some of these returns that we've seen were near term, although recently, as we've just discussed, there's been a bit of a correction. It's not to say we can't have continued upward momentum in some of these areas, but certainly the valuations are on the more expensive end. So all else equal, we do think that that equities largely face more headwind today than they did even just a couple years ago when they didn't have 25% back to back. Fixed income looks more attractive, hopefully also not terribly surprising, just given that rates have moved up about 60 basis points year over year. And as we know, when those rates move up, the prices of those bonds go down, and it's painful initially, but we do earn a higher coupon down the road, and tends to be a more favorable component to that. Now, what's happened as part of that with equities coming down and fixed income expectations going up, that's essentially squeezed the equity risk premium. And so what that's doing is flattening the capital market line and essentially having some implications on risk taking and where you'd want to be on that risk curve. Because if it's more flat, then obviously you're not getting rewarded for taking on additional risk. So we always have to be mindful of that. And Vince has been, I think, quite dedicated to reminding us that when you have a steep slope, it makes sense to seek a little more return. And when it's real flat, and in some cases, even on a geometric basis, the efficient frontier can turn over where you're actually getting less compound return. If you take on more risk, it's not just more return, the more risk you take at a certain point can actually turn over. Those are the kinds of things we really want to be mindful of. There's some structural changes, some you've already approved, another one you hear today across your private asset classes, so real return and real estate. These are on balance accretive to the overall portfolio in terms of the structural changes. So we'll see those flow through. Now for this, we have assumed that you're approving today's structure recommendation, but certainly if there were differences there, we could reconcile those. And would note that the funds, as you'll see when we go through that, they remain largely efficiently allocated, so they're either on the efficient frontier or very close to it. So no immediate need to make any major corrections there. And then when you look at the expected risk and return numbers, as well as the geometric or the risk adjusted return estimate, those have stayed relatively stable, nudged ever so slightly higher, and we'll talk about that. So that's really the framework of what you should expect and what you should see. And we'll walk through some of that. And again, let me know if you want more or less detail along the way. Any questions at the top?
Any questions from council members? Member Allen.
So, as you guys know, risk is my kind of bailiwick right now. And I will say that the corporate board directors I'm talking to are post-apoplectic. And I'm helping a number of people find jobs that have been laid off. And I hope either here or maybe we'll know more by the time we have our offsite that we knew. I think we really need to be talking more, and we've got experts right here with you guys, so I'm asking you this. I'm very concerned about the number of layoffs, the impact that that's going to have on New Mexicans, the cuts in social programs that are going to impact New Mexicans, the fact that the Japanese and others are going to the euro rather than the dollar for safety, the fact that we may enter another war. All of these things, the geopolitical and financial risks and sort of employment risks are something I've never seen in my lifetime. I mean, we've had downturns and we've had recessions, and we've had the Vietnam War that I've lived through, but this is something quite different. And I feel like we at the Investment Council need to be talking about that, about the impacts it's going to have on New Mexicans. I am full faith that Vince and John, and it makes me feel good that, you know, we're diversified, we're conservative in terms of how we're doing with this money. But I see states having to build the gap that's not being served by federal monies, whether it's to universities or to, again, social services, healthcare. And that's going to impact what the needs of the state are in it, you know, so it comes back to us, not only in the returns we receive, but also how those proceeds are going to be used. So I just want us to be thinking about that. So again, I'm going to go back to RK. Help me feel that this is more normal than it is, or that in fact, what are the key indicators that we need to be looking at that things may slide into a much worse situation than we have right now?
Yeah, thank you for the question. I'm not sure that I could alleviate some of those worries and concerns. I think it's you know, I think we're in somewhat uncertain times for sure. I think every week brings different headlines, and it's difficult to assess how much of that is reality, how much of that is fiction, what will be implemented, what will not. But yes, we expect, and as Vince noted, even in, you know, before in January, we expect volatility to be elevated for the foreseeable future here. Now these are longer term assumptions, so we feel quite confident that over this time horizon, that the expectations remain true. I think unlike many of your peers, you're in a much better position. We've talked about the strong growth of both the assets, but also the inflow. So you're cash flow positive. You have a lot of wind at your back in terms of taking advantage of dislocations, but that's purely from the investment and financial perspective. From the social and from the I would say the zero-sum game that you're describing that will impact different individuals desperately is going to have a differentiated impact that maybe isn't reflected quite in that way here. So I think it's certainly something to be aware of, and to the degree that we think it's more systemic and can affect long-term GDP growth or other metrics that would then flow through the financial system, those are going to get incorporated. But like most, we're in wait and see, and as things actually get implemented and approved, we try to reflect those. But don't necessarily take a view on what will be implemented versus not in terms of what's being put out there. So we try to have a good sense of what the range of outcomes is, but don't pretend to have any greater knowledge on what will happen in the near term than anyone else.
Member Allen, you still have the floor.
Okay, I just, again, with John and Vince, I'd like to see us have this as a topic at the offsite. And maybe in each one of our meetings for the State Investment Council, in addition to the economic outlook, just sort of the social political outlook that may impact either the income funds or the use of funds in the future. Thank you.
Thank you. Any other council members have any comments, discussion? I have one question for you all. I'm looking at page 13, capital market assumptions on the philosophy. The third bullet mentioning return, risk, and correlation. Risk has shifted quite a bit from what we normally look at as risk, even longevity-wise. I'm page 13, but I'm in my investment policy. It's the capital market assumptions philosophy. Page 15.
Oh, okay.
I think in the booklet,
All right.
depending which booklet you're on, page 50 or page 13.
Okay, yeah, I know. I'm familiar with the page. Yeah.
So on the third bullet, it mentions the three components are return, risk, volatility of returns, and correlation, relationship of asset class returns.
Yeah.
Risk looks very different than what we normally do for a shock analysis or for risk analysis or things that we factor in.
Yeah.
What was factored in on the assumptions that you guys look at, especially now that things are a little bit different?
Yeah, similar comments. We try to understand what the range of outcomes is. When you look at on a historical basis, we try to make sure that essentially a 3 standard deviation type event is covered. So we have that. I think there's been long recognition that standard deviation or volatility of returns, as it's defined here, is pretty narrow. It's a narrow definition that fits within a mean variance optimization framework, but is not all inclusive. So for that reason, we've supplemented that with stochastic analysis from Monte Carlo. We've started thinking about things in thematic groupings, so trying to understand what is the underlying source of risk in the asset class. So for example, you might have something like high yield or private credit that looks on the surface like fixed income or bonds, but really has more the features or the credit risk of an equity, and really should be thought of in that way. So making sure that we think about and allocate those assets appropriately. We also supplement this not necessarily at the optimization level, but at the does this allocation make sense? And this is more with at the staff level, but happy to bring some of that work to you as well if you're interested. And is essentially some of our risk reporting and factor exposures to try and see what is our sensitivity to currency, to commodities, to various types of risk. And what you'll find in most risk or return-seeking portfolios, so that the overwhelming majority, typically 80+% of it, the risk comes from equities. So that's the driving risk. There's other components, but that's what the underlying exposure is, even if you have lots of other things in there, like you do.
Okay, and then the assumptions takes out the alpha. You're looking at no investment of the alpha, but to
Yeah.
your point earlier,
Yeah,
when we're looking at returns
yeah,
and determining how much risk we want to take, we need to make sure that the fees
yes,
matches the risk and the return is
yes.
awarding us for taking that risk. And
Yeah.
that's not part of the assumption, correct?
No, that's actually the next step. We have an extensive active-passive study where we look at the persistence of outperformance across managers in different asset classes. And again, probably not surprisingly, what you find is that equity managers, particularly in the more recent decade, have had difficulty outperforming as interest rates have come down and essentially the markets have done really well. You've seen that in all the passive investing. So it's been very difficult. So that's an area where typically the incremental fees, although fees have come down, the incremental fees tend to be challenged. Then there's other areas like fixed income where outperformance is more prevalent. And, you know, for different reasons. And number one, you have to look at it. Number one, is it prevalent? And then why is it? A lot of times it's because managers will put a little bit of high yield in there or out of benchmark securities and just game the system, right? So it's understanding where is that persistence coming from, and then are we comfortable with why it's there, and then how much are we paying for it? So those are all very important decisions, but are more at the structure, similar to what you'll hear here, at the structure decision to say, how do we implement these things now? And just one important, I think, clarification on when we say we don't assume alpha. Some asset classes, it's very difficult to separate alpha from beta because of the way that they're structured. In fixed income equities, it's a little bit more straightforward because you can just assume index exposure. Once you start getting into the private markets, where either the index is a peer-based index, or there is some interrelationship between the actual manager performance and the broader asset class, then it's a little bit more difficult to separate those two. But generally, we'd like to lean more conservative on those and not bet the house on big outperformance from your managers. If we get it, great. It just adds to the return, but we're not relying on it.
And the last question, I'm looking at what you were referring to on page 52 or page 15, that small graph on the bottom, U.S. equity in red with an arrow down on
yeah.
U.S. equity. I just want to make sure in my head I have it clear.
Yeah.
Because of the way the market is right now,
Yeah.
even though we had an interim target, we hadn't quite hit it on U.S. equity or non-U.S. or
Yeah.
private equity.
Yeah.
That's a good thing at this point, in a sense, because of the fact that where we're at on the returns of those two buckets. Is that correct?
Yes. Yeah, I would say so. I mean, you're trying to still glide your asset allocation to your long-term targets, because that's your desired or your expressed overall risk exposure and return exposure. But yes, I think as the market shifts and Vince and team are looking at when, rebalancing, how do you get there prudently, but then how do you get there in a way that makes sense in light of market conditions, and those will change.
The reason why I bring that up is because if you remember about a year ago, we were talking about how much cash we had in hand. It was a great market environment for us to have a lot of cash on hand. Rates have declined a little bit, but the reality is it's still a good place to have our cash, because it gives us one opportunity for when things shift a little bit to our advantage. And two, it's not the right place to be right now with the current market. So I just wanted to make sure I pointed that out, because we shift our mindset based on what is shifted in the market, and this has been pretty good.
Yeah.
If no one has anything further, we'll move on to item 3C, real return structure study and investment policy statement update. And that's Mercer and Keith. Or is there anything further on your end?
I'm happy to cover as much or as little as you'd like. Did you want to see the impact on the portfolio?
Yeah.
Maybe just quickly. That's page 9 in the deck. That's the one page I would cover. And then again, lots of information for those fund by fund that want to dig in. right there. And this is just a change for each of the funds. Now, you recall that we've started grouping them by essentially their ability to take on illiquidity, by their return target, but also whether the funds can be appropriated or not. So those funds that can be appropriated will tend to have a little bit more built-in liquidity, higher levels of yield or income. And those that are long-range funds, some of the more true permanent funds will have that longer-term allocation. So here you can see essentially what we try to do is deconstruct or provide some attribution on the year-over-year change. That first column, you can see the expected return, high growth, 7.19, growth, 7.06, and then all the way down. Now, these are geometric returns, so those are already accounting for risk compared to the arithmetic return that you might see as the top line number. And you can compare that to the 2024 expectation. You'll see that they all moved up. The year-over-year changes on the far right-hand side, all of those are green, modestly up somewhere between 6 basis points to 28 basis points. And there's two different drivers there. Call it beta change and methodology change, but really the beta change, the way I think about it, is change in expectations for capital markets. And essentially, what you'll see there is that the ones at the bottom that are more fixed income or capital preservation focused, like stability and workforce development, are quite positive there. That's because they have more fixed income, and we think fixed income is going to do better. So that's the rationale for that. The ones that are higher up, where you see a slight negative on those numbers, we're saying just that the change in expectations is actually a slight detractor based on their exposure to higher exposure to equity, which is moving down. And then we have a methodology change, but really it's a structural change, and that those are the asset classes that have benefited from the real return changes that are impending the real estate. And you see that the higher growth and longer range funds are benefiting from there. So high growth is up 16 basis points as part of that growth, 15 basis points. And that's, again, that shift and that higher exposure to those private market asset classes that are continuing to get restructured, refined, and should provide better risk-adjusted returns on a go-forward basis. And so when you combine those things across the board, you'll see that the returns have moved up ever so slightly. So that's positive results.
Just for high growth, that is the water trust and the rural library. Land grant follows it in under growth, and
Yeah.
early childhood, and severance tax is growth. Within state PE, and moderate growth is where early childhood falls.
Yeah, you see that all defined on the prior page for additional reference, along with the various metrics, what their distribution rate is, target return, exposure, and some of the key performance highlights at the bottom of that page. And as we add more funds, I think this framework hopefully makes sense for us when we try to find like funds, but let us know if this framework is pragmatic and sensible for you as well.
Madam Chair.
Member Tejas.
Madam Chair, real quick. You just mentioned that the water trust fund is really a high growth portfolio.
Yeah.
Did I get that right?
Yeah.
Yeah. If you look at the efficient frontier, that high growth portfolio is towards the far right side of that chart.
Yeah.
Is that a reasonable portfolio to have at this point, or does something need to change with that? Because, we're taking on more risk, with, I don't know if it's the nominal amount of return on that.
Yeah. Well, I think it's a great observation. The page 11, I think 2 down, you'll see that this is a summary page where we have all the efficient frontiers overlaid, and these are in geometric terms. So that's typically where you see that curve turning over, where you're getting less, and that tends to happen in portfolios 9 and 10. When you look at that placement of that square, you see it's portfolio 9. It's second to last. It's not the very, so that last dot on the very right hand side in orange, that's 10. it's not labeled here, but that's the way we sort of think about it. There's 10 portfolios. And so essentially where you are is right below that ninth diamond, the second from the right. That's the orange square.
Correct.
Yeah, and so you'll see that the slope of that curve actually is trending upward up until about right at that point. And then from there, it starts to flatten out between the second to last and that last dot. And so that placement is intentional because you're still getting incremental return for taking on risk. But if you were to go much further than this based on that, then you wouldn't. So that's why you're there and not all the way on the far right-hand side of that chart.
Interesting, Madam Chair and Matthias. I did not notice that curve did kind of have an inflection point a little bit,
Yeah.
faster rate there.
Yeah.
I just thought it was a continuous kind of curve.
Yeah, no, they're not linear, and the shape will change over
Okay,
time, and that's,
so that makes sense.
that's what I'm saying. In some cases, it will be steep all the way through, and in other cases, it's even flatter earlier in the curve, and so that's where that matters. Yeah. So that's exactly right.
Okay, thank you for that.
Wonderful. Okay, go ahead
Thank
and
you.
keep on proceeding.
Thank you for the time.
Oh, wait, you're done completely or? Because I do have a question.
Oh, sure, yeah, as many questions as you'd like.
Let me go to page 24. I'm sorry, I have the wrong packet.
No, I
So
think
it's
I
the
don't.
capital markets line 2025 versus
Yes.
2024.
Okay, yeah,
So page 61, page 24 on the
Okay.
old packet.
yes,
Are we there?
yeah, I think
So-
I'm there.
I was looking at the expected compound returns on the 2 pages before, and then the capital market line, and I wanted to see if you could go over that a little bit for the council.
Yeah, sure. Should I start on page 23? Maybe 2 back on that you're referencing there. And this is something that we look at on a periodic basis because I think it's relevant primarily as you're thinking about how realistic your return target is over the long term. There have been some years where, getting to a 7% return target is quite easy because lots of asset classes are expected to earn above that. And then there's been other years, especially after very strong market returns, where there's maybe only one or no asset classes based on our expectations that are really above 7%. And what this shows is that you have a number of asset classes, 5 or so, across the most risky that you would expect, earning above 7%. So you can get there. Now, of course, by the time you combine them, we do know that correlation or diversification is kind of the one free lunch here that can help move that overall geometric return even further up. But so we're in a good sort of starting position to get to our return targets, and I think you've seen that with some of the numbers that we showed you in terms of expected returns for the various funds. I think probably the bigger story here, though, is that on the very far right-hand side, those last 5 or 6 green bars, those were almost at the very bottom for a long time. They weren't expected to earn much of anything. That's your traditional fixed income, plain vanilla, treasuries, other things that really didn't have a place in the portfolio. And some investors started questioning, well, why do we even have bonds in here? They're not earning anything. Well, things have changed. Interest rates have moved up and these have come off the bottom of the page. And so now, even though they're not getting you to 7%, they're helpful in terms of diversifying. They're helpful in terms of providing you downside protection. And now they're earning a reasonable amount of return.
And liquidity.
Yes, of course. And a great source of liquidity that you have available to you. So that's sort of the starting position of this. And it's great to see because it's actually probably better to have them all across the board near 7% rather than some that are really high and some that are really low, because in some ways it limits your ability to allocate those assets. And then on the capital markets line, yeah, two pages down. This is what I was describing, looking at the capital market line and the slope of that line, especially on a year-over-year basis. And if that line, the slope of that line steepens from one year to the next, that typically would indicate it's an advantageous time to go a little more aggressive. And when the line moves moves the other direction, moves down, then perhaps you would take a couple chips off the table. Now, this line is not moving massively, but all else equal, based on the shift in lines here, you can see the dashed yellow line is last year, 2024. Solid blue line is this year. You'll see that that line has ever so slightly shifted down and is a little bit flatter. All that's to say that if we had a choice between putting on more risk or taking a little risk off, we would go likely take a little risk off, or at least think about that trade-off carefully. Now, again, this is not to say that you would need to change anything. I think your allocation makes a lot of sense. But this is just another lens that we look at to say, when we're thinking about asset allocation, which direction should we be heading?
Okay, thank you. Would you like to move to item 2, asset class assumption detail, or are you done with your presentation?
I've covered everything that I think we've intended to cover. We can look at it fund by fund. If you'd like to see the return detail in greater depth.
Can you just let the council members know what is in asset class assumption detail? We'll start there, see if they have any questions or they had any comments, and if they don't, then we'll move on to asset allocation. So.
Okay, perfect. Yeah, the under 2A is the asset class assumption detail, and that just provides additional essentially rationale for the direction of each asset class's assumption change on a year-over-year basis. So whether something stayed the same, moved up or moved down, and what the driving forces behind that were. I will just say each of the asset classes, maybe this is instructive as a whole, and then we can go from there. For each asset class, essentially what we try to do is look at the various return drivers. What is a driver of return? Typically, it's there's some form of income, so yield, or whether that's through a dividend or a coupon, some kind of income component. There's some kind of a growth component. There is a valuation component. That's usually the one that's most volatile, and then there's also, especially when you're looking at non-US markets, there's a currency component. There was a discussion on currency earlier, and you'll see that reflected in our expectations that we actually do think that the dollar is a little bit high, and we anticipate that that currency adjustment over time will be a net positive to non-US markets, and you see that reflected in our numbers. We have that. That's on page 18, and we're currently on 25. So there you see for the various asset classes, the various building blocks and our expectations for them. So in that peach orange color, that's earnings growth, or essentially growth includes both GDP but also profit margin. The yellow, that's the yield, and you'll see that the yield in US markets is lower than non-US. And you have your regional inflation assumptions, 2.5 for the US, and then a little bit differentiated for the various non-US regions. And then in that brownish color, that's valuation, and you'll see again for large mid-cap US equity, that's negative by a sizable margin, just given the valuation headwinds that we described. And it's actually a net positive once you move out to some of the non-US areas. And then the currency component is the very top bar on the 3 most right columns, and that's currency. So you see that that's net additive as well. That's how we think about constructing it, and essentially look at each component. What are the components? Value that, and then build it back up together. And you'll see that asset detail starting on page 34 for inflation, which is a component to all the assets really, and going forward.
So that page summarizes virtually everything that's in the asset class section.
Does anyone have any questions on this section? I would note in my packet, the in-state private equity program, page 46, I'm sure Member Bingaman would love to see that portion. And if you can also talk about the SBIC, I noticed that in here as well. On page 47 or 84.
Yeah, I see it. Yeah, so this was a year where, you know, historically we've broken out the in-state private equity program. And this year we try to take that one step further. Now, this is, I would say, a learning process. And we're welcome all feedback in terms of what expectations around those two programs might be on a go-forward basis. The return expectations for both of these is modest and sort of reflects the combination of both historical performance, but also but forward expectations to the best that they can be defined. I think there's a recognition of the dual mandate that these buckets tend to have in terms of not just generating return, but also having a positive impact more on a local basis. And both of these are in transition. So there's some legacy assets, legacy portfolios, but I think there's been a lot of progress made in moving those in a direction that make them more sustainable and more meaningful contributors to total portfolio returns. So at present, we essentially have a modest return expectation on an arithmetic basis of 3% and a lot of volatility around that just because of the uncertainty of outcomes there. But I would expect as that program matures and as we get more feedback and better understanding of what we could expect out of that for that to trend higher.
We'll be coming back with more on that in a couple months on the.
Yeah.
And I think the next page, SBIC, that would be something that the council should probably get a little bit more information on, because I've learned a lot from staff about that program.
Mhm.
You know, right now is not the right time, but I
Yeah.
think having a little bit more knowledge about
Yeah.
that would be good. If there's nothing further on that end, you want to go to asset allocation studies, section 3?
Madam Chair, one question. Where's your actual projection for those state funds? Do you see it remaining at 3%? Do you see it lower than that? I mean, these are not spectacular.
For the
In-state funds.
Yeah, I think the returns have been challenged. And
That's using a euphemistic term.
yeah. Yeah. Right. And expectations are that, you know, they should improve. But you know, for us, we're cautious to have high numbers until we see that materialize in a meaningful way.
And Madam Chair and Member Sommer, we will be coming next month to the council with a structure study for the New Mexico private equity program. And that's going to cover why the program didn't succeed in the past, why it didn't succeed in terms of returns, why it didn't succeed in terms of New Mexico economic impact, and what changes we've made over the last couple of years and the trajectory we want to take moving forward. So we completely recognize you know, a negative geometric return assumption is not what anyone had in mind when the program was developed, along with the extremely modest job impact the program historically had. Yeah, Director Chris Cassidy has made some fantastic changes to the program over the couple of years. But I think it's time for us to adopt a policy reflecting the changes that he has made and reflecting the commitments that you have voted on over the last couple of years, because there has been a significant change, but it hasn't really been reflected in an official policy adoptment, hasn't been reflected in an official structure study. So we will be coming with that next month. And I think that will help answer a lot of the questions about the historical lack of success for the program, but why we have some real hope for the program moving forward in terms of both returns and economic impact.
Madam Chair, one other question. When you do this study, are you going to take into consideration the maturities of these investments and when they pay out and what the need is for the state for the drawback?
I think those are refinements that we've discussed, as future refinements, yes. And looking at also a more, differentiated or perhaps a closer look in terms of historical performance versus the more near-term performance that, that John is describing, because we're expecting a very different forward expectation from history and wanting to acknowledge that. So you should expect to see both of these assumptions changing and being refined over time as we all learn more about them.
Madam Chair, this question for John. Are you taking into account the total return on this and the actual return in nominal dollars?
Madam Chair and Member Sommer, yes, you'll see in the structure study, the goal is to get to buyouts of these venture capital startups where we see actual returns. The one thing that the structure study will also lay out is we want to break out the performance for the projects that would fall under this new structure study, and that includes projects that you voted on over the last couple of years versus the legacy program, which will still be on our books for a long time to come, and we anticipate continuing to be a drag on our performance for a long time to come, but which we have no control over at this point. It was largely, investments made pre-2016. So we want to break that out so that we at the team level, you at the council level, will be able to see what the performance is for this new program versus the legacy program, because I think the results will be wildly different.
Thank you, Madam Chair.
Thank you. Do any other council members have any questions, concerns, or comments? I would just point out, I think that's a great presentation to have, and I would take it one step further to invite everyone who put that bill together, including Legislative Council Services, analysts, and some other folks. So that's the New Mexico Grow program. The other one that I think is important is the connectivity with SBIC. And maybe Russ can come to that portion of the meeting, because SIC did a lot of work to show proof that it's not just return that matters, but for example, with the SBIC program and the New Mexico Grow program, those two were not just for rate of return. They were also to help with small businesses in New Mexico. And so a lot of the return is not on the dollar amount, but on how many jobs you created, how many businesses started up here, and all of that does have some type of value for New Mexico and New Mexicans. And I think that's just as important to make note of. Section 3 asset allocation studies, is there any comments you want to make on that end?
We've covered most of it. I think if we can flip to page 53 quickly, you'll see that the three primary fund, land grant, severance tax, and early childhood make up the preponderance of the assets. You have some high growth funds, water trusts, rural libraries. Those are able to be higher octane because they're small in size and the liquidity can be afforded by that. Something else, a larger fund perhaps would be a little bit more challenged to get the types of private market exposures that you would have on those. And so you see the changes or the allocations on 55, 2 down, along with some definitions. Again, there's a lot of information here for anybody that wants to see that. But you can see high growth on the left-hand side, private equity at 25%. Now, if we had a target for land grant at 25%, that would, as Marcia was indicating, would take a long time to get to because the dollars are so much higher. So we do try to find targets that we would like to achieve, but also that are achievable in a reasonable time frame, because we can set unreasonable targets all we want. If we can never get there, then it's not terribly helpful. So these are targets that we think are attainable in a reasonable amount of time, and that obviously will serve the funds through various market cycles. We've covered the rest. Really, from there it just goes page by page into detail for each of the funds, but we've covered all the summary pages. So unless there's specific questions to any of the funds, I would stand for any questions or comments the council has.
Are there any other questions or comments for RVK? I would just say your new data and graphs are amazing. and easy to read, so
Oh,
thank
good.
you.
Thanks for
Okay,
the
if
feedback.
nothing further, we'll move on to item C, the real return structure study and investment policy statement.
Thank you.
Thank you so much for your presentation. Mercer and Keith. And as they're getting ready, I think we have an honoree with us that got an award from the Power 100. So if Amy could mention what that award was, I think that would be very amazing, and congratulations to you.
Thank you very much, Madam Chair.
Tell us what it is.
So, yes, last week found out I was the recipient for the second year in a row of the DEIC Power 100, which reflects my work in getting more capital to high-performing, diverse managers. It still continues to be an underrepresented area that doesn't get a lot of capital. So I lead it at Mercer, and we have brought some in front of you as well, so you've been part of that as well. So thank you for your support, and thank you for the recognition. I appreciate it.
Congratulations. We're
Thank
happy
you.
to have you as part of our team.
Thank you.
All right, let's see what you guys got today.
Thank you and good morning. We'll start off with the structure study beginning on page 156 of the board book, and directly following it on page 181 are the IPS revisions. You obviously have met Amy from Mercer, and I wanted to also take a moment before I kick off to acknowledge the assistance of others in the preparation of this study. Specifically, I'd like to call out Juan Turbizo, Don Iglesias, and Nino Carpenito for components that they helped to contribute to this overall process. Let's move forward to the next page for the executive summary for a quick overview of the structure study. Two key priorities for the structure study. Number one, we want to eliminate the financial assets bucket and reorganize the structure to facilitate improved reporting. And then second, we'd like to adopt a benchmark change to better capture the expected returns associated with the profile of the portfolio's investments. I'd also call out that during the course of this presentation, you'll see a number of slides that speak to the diversification of the real assets portfolio. I think the diversification is a key component of this effort. With respect to reporting and transparency, I want to start off by level setting on two key items. One, I'll use the term market multiple times during the course of the presentation. We're using a roll-up of NAV from Preqin to represent the market. This obviously has some selection bias built in. Most of the Preqin data is publicly reporting plans, and the objectives of those plans may differ from our own. And so I would suggest that we look at these roll-ups as representative of the marketplace more broadly, but more of a touchstone than a clearly defined benchmark for market-related exposures. The second key element of this presentation is we're beginning to view the portfolio through a look-through process. What I mean by this is each of the 700 plus investments in the portfolio have been tagged by a risk factor such as industry or geography, and we roll up our exposure reporting by summing the NAVs associated with these particular characteristics that I'm speaking to. To see the importance of this look-through concept, I would just give you a simple example. If we had a three-fund portfolio that was comprised, each of the funds identically of 40% midstream, 30% transport, and 30% for digital, for argument's sake, if we were to do a top-level classification of that fund, we'd say each of those funds is a midstream fund, and therefore we would report basically 100% of the portfolio would be midstream. The look-through process actually rolls up those exposures, and so we would report out 40% midstream, 30% transport, and 30% digital. And so it gives us much better visibility into what the actual exposures in the portfolio will be. With that groundwork laid, I'll hand off to Amy to discuss the role real assets play in the portfolio and to talk about the current portfolio itself.
Great, thank you. So on page 159, just a quick snapshot of your current real assets portfolio and the current categorizations. As Keith mentioned, we are going to walk through some different ways that we want to look at the portfolio, but this is how it is broken out today. You see infrastructure is your largest exposure, and we will be discussing more about how to diversify within the infrastructure bucket. But it is 57% of your NAV. It's also your highest performing by IRR and the net multiple. And then on the next page, we want just a quick reminder, and I think it ties in well to some of the conversations we had earlier of what should you expect from your real assets portfolio? What does it play from a total portfolio perspective? So you should see some inflation hedge that comes from here. From this part of the portfolio, lower volatility than you'll see in some other parts, that there's really a lower dispersion of returns. These are long dated, high barriers of entry, contracted assets. And so you see just kind of lower volatility. You know what to expect from this portion of the portfolio. More predictable cash flows. That's both from a yield perspective, and that's something that Keith and I talked a lot about. He'll talk about that you can really put in the portfolio based on different risk profiles and strategies. But we should have more predictable cash flows from this portfolio. Lower correlation to other asset classes such as private debt and private equity, and strong yield potential. Again, we know when we're going into funds based on the strategy and the profiles of the expected yield that we can get from that portion of the portfolio. So I'll hand it back over to Keith to talk through some of the key changes based on what we've been looking at.
So if we move ahead to the next page, we have a single slide. It's basically the real asset structure study in a single slide. If you look at the left-hand column on that page, we see the current structure as it exists today. And then on the right-hand column, the structure that we're proposing moving forward. The higher level basket limits are in the margins of each respective column. Key things that I'd like to call out here include, one, we want to eliminate the financial assets bucket. And instead, the bottom left-hand quadrant of this slide will become the overall real assets portfolio. You'll see that the yellow infrastructure explodes basically and becomes a large single bucket within the real assets portfolio. And that will be subdivided, as you can see listed further on that page. And we'll provide some additional detail with respect to that as we move forward. The other points of note on this page, the MLP, Master Limited Partnership exposure, will move into midstream and downstream infrastructure. This is a case where, for a reporting perspective, we think it makes sense to group assets with common underlying businesses. And so the MLPs are midstream related exposure, and they will join the private midstream related exposure, which will be carved out of the old energy bucket and be present in the infrastructure bucket in the new real assets structure. The upstream energy related exposures will move laterally into the hydrocarbons bucket of natural resources. So essentially that's saying they will stay in the natural resource area where they had been previously. One element of the bands that you may find a little bit interesting is that we're looking at 75 to 95% bands for the infrastructure category. And on the next page, we'll discuss the rationale for why that sector should be as high as it is. Let's move ahead. On this page, I would highlight a couple of things. One, this is again a roll-up of Preqin related data where we're summing the NAVs of infrastructure funds within the Preqin database and separately summing the NAVs of natural resource funds from within the Preqin database. The lines are the NAV lines. The bars are representative of market share split between infrastructure and natural resource funds. The boundary between light and dark is the boundary between historical on the left-hand side, and the darker lines on the right relate to an extrapolation of the recent 5-year trends to see what that would imply about where the mix between infrastructure and natural resources would ultimately wind up. Based on our analysis, you'll see that the current market share of infrastructure is about 84% within the Preqin universe, and could quite easily grow into the mid 90% range. And if you were to posit that this trend could also reverse, and we went back a few years in time, then a 75% lower bound would make sense. And so we've tried to be diligent about bracketing the likely evolution of the investment opportunity set over time. Let's move forward to the next page. This is a snapshot of the SIC's current portfolio. You'll see that infrastructure on a look-through basis accounts for about 82% of our portfolio. And again, against the Preqin universe more broadly, that was at 84%. And so we feel pretty comfortable about where that value sits. On the right-hand side, you can see the target ranges that we're suggesting, both at the aggregated level, so infrastructure and natural resources, and at the subcategory levels. Those subsectors of the market that tend to have a greater proliferation of investment opportunities will be having larger maximum limits for their exposures. And so there we're talking about the digital, the energy and midstream spaces, logistics and transport, and utilities. What I would also highlight is that when we buy an infrastructure fund, a general infrastructure fund in the real assets portfolio, the managers of those funds will invest across multiple of these buckets, and they will move to deploy capital where it can be most efficiently deployed at any particular point in time. Therefore, we won't have very robust fine-tuning capability of those related exposures, and that's one of the reasons why the bands are relatively large for each of these subsectors. If we roll forward a little bit, we want to highlight again, the diversification within the infrastructure categories. My slide 9 has a quick summary of some of the subcategory investments that might be representative within each of the subcategories. In response to Treasurer Montoya's recommendation that we include additional detail, we'd added a table in the IPS that drills a little bit deeper into each of these subcategories. If we page forward yet again, this is another way to highlight the differentiation that occurs within the infrastructure subcategories. The chart shows valuation multiples on a number of different subcategories through time, and you can see that they do indeed behave quite differently through time. And so that's why we want to impose bans on the sector constraints for these subsectors. Let's move forward another page. This chart shows real asset market shares by risk profile. Again, this is reliant on the Preqin data. What we see is in the publicly reporting plan universe, about 70% of the assets are core or core plus, and then the remainder is value added. By its nature, this analysis is a backward-looking one. Anecdotally, Amy and I have seen a large California pension fund change its mix and shift it more toward the non-core investment opportunity space. And another large sovereign wealth fund has indicated that they're targeting minimum net IRRs on their investments of 12%, which suggests that they're at the very high end of core plus and then into the opportunistic and value add portion of the investment space. We roll forward one additional page. We have a summary of risk profiles. It basically demonstrates the expected returns, representative expected returns for funds in each of the various categories. As you move from core on the left to opportunistic on the right, you'll see expected returns go up. The other feature of this chart and the nature of infrastructure investments is that as you move from core toward opportunistic, the share of the total return derived from income decreases. So we're more reliant on capital appreciation of the underlying investments as we move from left to right. Moving forward, another page, we're looking at the current and planned exposures within the SIC's portfolio. Currently roughly a 50-50 mix between core and non-core. Based on where we see the market opportunity set currently and evolving over the intermediate term, we expect that we'll be shifting more toward the value add and opportunistic segment, probably toward the upper end of that range. The next page is another way to look at the diversification within the portfolio. Again, we've defined the market as a roll-up of frequent reporting funds. The key call out here is that the SIC's portfolio has historically had a home country bias. You can see that by virtue of the fact that we're around a 78% exposure to the Americas, which is quite large relative to the frequent universe, and underweight in a geography, Europe, for example. What I would call out here is that recent allocations in the real assets space have been taken to mitigate some of the magnitude of this gap and improve the overall portfolio diversification from a geographic perspective. In particular, allocations to EQT, Anson, Ardian, and Copenhagen will all tend to move that needle toward a more diversified position than we currently see reported here. These moves will happen on a lag because, again, we're talking about doing a roll-up, look-through kind of reporting. And so we won't see those changes reflected in this table until the managers have made investments in their portfolios. So this will take a little bit of time to manifest. The next slide is another representation of diversification by geography. Here we're using the MSCI geographic breakout, and you can see that is very similar to rolling up the Preqin. The reason for presenting this particular slide in this manner is we wanted to call out the OECD versus non-OECD exposures. The current language in the IPS, which we recommend does not get changed, is for no more than 30% of the portfolio in non-OECD countries. And so just wanted to present this from mostly a compliance perspective. I hope the summary so far has shown that we do have a very broadly diversified portfolio, and that the plans going forward will continue to emphasize that diversification. With that, I will hand off to Amy.
So the next section we want to cover is a proposed benchmark change. And this is, so currently the benchmark for your real assets portfolio is CPI plus 300. Again, that's the inflation, when you get the inflation protection. So we do believe CPI continues to be the right benchmark, but with the removal of the debt-related assets, which were lower returning investments, and the slight tilt now to more value-add and opportunistic, which are higher returning asset classes, we do think that it makes sense to move from the plus 300 to plus 400, and that will better reflect the return profile of what we're presenting in the changes in the structure study. Interestingly, on the right-hand side, we did it shows the benchmarks of the largest US public pension plans, and you see CPI plus 400 and 500 are the most used benchmarks. So you are in line with that. We wouldn't go all the way to 500 since we are keeping some of the core and core plus exposure because we do want some of that yield generation that comes from that area of the portfolio. So we do suggest changing it to CPI plus 400 basis points. And it will take some time though, so I'll turn over to Keith to go through the pacing. We do want to set some expectations of, yes, we're changing it, but it will take us some time to get there.
The next slide shows the history of recent year commitments and what we're expecting going forward. The quick and dirty summary is that over the course of the next 5 years, we expect to deploy something in the neighborhood of $6 billion. There is a chart in the appendix on page 23 of the presentation that details the preceding 4 years of commitments. What I would make note of here is that the deployment pace has been very aggressive and continues to be upward and to the right. The downside of such rapid pacing is we build up potentially a relatively large pool of committed, not called capital, and that's a feature that drives what is in the industry considered to be the J curve, and I'll hand off to Amy for a couple of comments related to J curve implications.
Yeah, and I know we have talked about this in the other structure studies, and we often talk about it. Just the J curve of deploying so much more capital in the past few years and then moving forward, because these investments do take 3 to 5 years to actually get that capital out. We do expect the early years of a fund to be negative, and so that will be a drag on performance for the next few years, we believe. We are looking for anything that we can to mitigate any portion of that. We're looking at things like different SMA structures that would help alleviate some of the J curve. Season primaries, there's been elongation of the fundraising cycle in infrastructure, so you've even seen it. We've brought a few opportunities to you that already had capital on the ground and were out of the J curve when you all approved an investment in those, and then co-investments. So we are looking for ways to do that, but we just want to make sure to highlight, like in the other asset classes, as you've heard, we do expect just with that increase of deployment of capital to be some drag on the performance over the next 2 years. It's been modeled out that it may be around 200 basis points over the next few years.
The next page just highlights some of the merits of doing co-investment vehicles. More broadly, the approach that we've taken to date is a co-invest alongside a main fund where we expect that the fund itself will generate a reasonably diversified offering of co-investments. What I would say here is that we have had relationships developed with some managers who have maybe somewhat more concentrated portfolios where we didn't think a co-investment vehicle as a standalone would have more than, say, 1 or 2 investments in it. And so from a diversification perspective, that winds up being a challenge. So one of the initiatives that Amy and I are contemplating for a subsequent meeting is bringing another co-investment vehicle that would enable us to capture some of these one-off co-investment opportunities that we have missed by virtue of the way that we've been pursuing things to date. Generally, co-investments are an extremely good idea from a risk-reward perspective. If we go forward to page 20 in my deck, the next slide, you can see what the SIC's investment or co-investment track record looks like. The top panel is paired co-investments, so a diversified sidecar of the main fund compared to the main fund. And then the the bottom panel on this page demonstrates a roll-up of treating the co-investment portfolios in aggregate as a single portfolio, and comparing that to the primary fund investments in the real assets portfolio. So we are emphasizing efficiency of implementation, and the co-investment approach is a very good way to pursue that. And again, we will expect to bring another vehicle that will allow for taking one-off co-investments from GPs and pooling those for reporting purposes. We go to page 21. It's a quick summary of the real assets structure study. That's page 176. Quickly to recap, what we need from council is support for the following items. One, want to eliminate the financial assets bucket and approve the structure as presented within the slides. Two, we want to adopt the subcategory and category ranges as those are defined in the slides and in the IPS draft. And then finally, we want to adopt a 100 basis point addition to the benchmark for the real assets portfolio. That would imply moving the benchmark from CPI plus 300 basis points to CPI plus 400 basis points. That concludes our formal comments. I would open the floor for questions.
Thank you. Does the council have any questions for this section? Starting online? In the room? I just had one question on page 24, the MSCI geographic block definition, and it has all the different countries and all the different areas. I know Member Ellen had mentioned a question before about China, so it brought my attention to this graph. Are there any countries that we're not thinking about investing with at this time, or is this the list of everyone we plan on investing with as part of our policy?
So the MSCI block definitions are those that MSCI has established. We have current restrictions on Russia and Ukraine investments specifically, and those are included in side letter provisions. Beyond that, there aren't explicit prohibitions. So I don't, yeah, I would just say we don't have specific prohibitions on the countries that we would look at. The prior conversation was one around the home country bias and the fact that we do have very many more domestic assets than we have international. And we've taken and made numerous commitments in recent periods to general partners with exposures outside of the U.S. that will help to diversify the portfolio over time, and we expect to continue to pursue those sorts of opportunities.
Thank you. Member Summers?
Madam Chair, in light of the current economic and political situation, does this make sense? I mean, to start looking for, I mean, what looks to me like the politics is forcing domestic investment.
I guess I would look at that from a couple of different perspectives. As RVK had mentioned early, it's pretty difficult to sort out what is anticipated to actually happen and what may be prevalent in the headlines. And I think over a longer term, the mix that we're speaking about does make sense. I think a kind of a microeconomic level example of this would be in the data center area, for example, right? There's a tremendous need for power going forward. The power that is going to be supplied is going to be the cheapest to supply, right? That's what people are going to demand. And even without subsidies, wind and solar factor in as lowest marginal cost supplies of power. And so economics may drive a continuation of investments in these areas on their own rights.
Thank you, Madam Chair.
Any other comments or questions? If not, we'll go ahead and move on. You're, Mr. Chairman, you're gonna go over the investment policy next, correct? I mean,
I'm sorry.
that's correct, correct?
No, it's included in there. I wasn't going to make any
Oh,
further.
I'm sorry. I thought
further
you were gonna
comments.
go through the detail of the investment policy next.
No, I'm
No? Okay, then I do have questions.
sure.
So let's go ahead and go to the investment policy on page, actually, I have different page numbers than you all, so let's just start at the beginning. Okay, so my first question is, you changed the objectives back to the same order they already were, correct?
We did revert them. We thought we were implying prioritizations in there that may not be necessary.
Okay, and I do want to point out to the council, they added in the change of our mission statement to this policy, so I'm very grateful for that. There's a smiley face on my page. If you go on to the next page, we still need to clear out that space on portfolio allocation, but I just wanted to make sure the change to metals and materials was added, but mining was removed. And I didn't know if you meant to put that or if you want us to keep mining in.
I'm sorry, I'm having a problem.
And
getting
we're
to
in the
page.
graph on page 2, under strategies. Let them get us to that point. We're in the investment policy, so keep going. And metals and materials was put in correctly, but mining was removed, and I think you wanted to keep mining only because I saw it. I think I saw
Yeah,
it
so
in,
the adjustment for naming purposes, we're just going to use metals and materials, take the mining language off, but it would
so you're okay with
that
it?
activity, yeah, that activity would still be included in that bucket.
Okay, page 3. Then we don't need the mining there, but I appreciate that you cleaned up the categories. The only thing I would ask, and it's just a formatting issue for later, is putting the infrastructure in alphabetical order and then putting the natural resources in alphabetical order. And that will be very helpful when you go to page 4. That got cleaned up quite a bit, so I think that looks great as well. And keep those in order to infrastructure first, natural resources second, similar to your first graph. And then on page 6, my suggestion would be where you had infrastructure / digital midstream, all of that section, that's the third grouping. I would keep infrastructure bolded and keep your digital midstream and all the other items that you have in there as the first one on top. And then the second grouping is all of your natural resources. So keeping natural resources bolded, and then your sections of agriculture, then hydrocarbon, and then timberland.
I'd like to address the rationale for adding the infrastructure
Separate?
investments table that was added to the IPS. The purpose of the table that you're referring to immediately, so that's page 188 or page 6. This table is designed to show the risk profile of investments that would fall into either the core plus bucket or the value add or opportunistic bucket. The differentiators of risk profile tend to be things like the share of a project or a portfolio that is development oriented, or the degree to which an asset or portfolio might be levered, for example, or the degree to which commodity prices or other input prices, revenue streams may be hedged. Those factors tend to be common across all of the infrastructure subcategories. And so we wanted to be parsimonious in our specification of this table. And we tried to accommodate what I understood to be a request for more detail in what investments would fall into infrastructure by providing that more in-depth table.
Okay, so you wanted to make sure and take off the red line that you had from the CIC on infrastructure, keep it all holistic.
Yes.
Okay,
Yes.
thank you. And then on the other items for farmland, hydro, carbon, and timberland, it'd probably be good to keep them all under the natural resources, like in that section area.
Yes.
That's just formatting, that doesn't change context. And then, of course, the metals and materials. And then moving on to page 8, asset type diversification. Same comments, just in the same order, and making sure what you're titling now is natural resources versus infrastructure, and then putting the sub portion right under, I think would help everyone for consistency, or for people that you decide are consultants that work in a lot of different places, they know exactly what bucket you're referring to on your policy. And then, Mr. Chairman, that's as far as I got on the changes from the CIC to the SIC. So if there's anything other changes that were made between now and CIC, if you could state them to the council, that'd be great. Are there any?
I think the only material one was the addition of the infrastructure subcategories.
It wasn't anything else. We were just trying to get I think the one the treasurer went over, or the changes that we had made for
Right.
the next week
Right.
to accommodate those requests. And the only thing that I would say is, we did hear you on the opposite.
The microphone is.
Sure, sorry about that. The only thing I would say, Madam Treasurer, is that we did hear you on the alphabetization, but on a red line document, it's a nightmare for track changes. So happy to fix that in formatting, if that's the will of the council. That's not an issue, but on a track change document, it
would be
made
an
it messy.
Definitely. Okay, that was all I had on my end. I think you guys did an excellent job. There's a lot of work. You went in detail with the CIC on this, so I think this leads us in the right direction of what they were talking about a year ago, and putting these buckets to be more clarified so that we really know what we're invested in and how much we have invested in each one of those buckets. And so it helps with the diversification aspect. And I do want you and Member Bingaman to know, I have not stopped thinking about the changes and how I felt about them, because I didn't know if it was a knee-jerk reaction or if it was a philosophy or if it was a thought process. And a lot of the information that RVK gave us today actually made me lean even more towards the importance of diversification, and some of the comments that Vince Smith made, especially now. The other thing I would mention just for everyone is that you always see how people handle chaos and stress. And that really shows the amount of character that people have. And I just want to point out to our consultants and to SIC and to our council, everyone has done such an excellent job through all of the quote chaos or change or shift. And I just wanted you to know that I appreciate working with all of you. So I entertain a motion if anyone is interested.
Madam Chair, I'm happy to make that motion.
Thank you, Member Bingaman.
Based on the recommendations of the Council Investment Committee, Advisor Mercer, and SIC staff, I move that the State Investment Council approve the updated structure study and investment policy for real assets as discussed by and memorialized for the Council at today's meeting.
Second.
We have a proper motion and a proper second. Is there any discussion? Seeing none, let's call the roll.
Treasurer Laura Montoya,
Yes.
CFA Secretary Wayne Probst,
Yes.
Nick Teas,
Yes.
Catherine Allen,
Yes,
John Bingaman,
Yes.
Alan Sanchez,
Yes.
Kurt Summer.
Yes.
That's 7 in the affirmative, motion passes.
Wonderful. Thank you very much
Thank
for your
you.
work. We'll move on to item D, private equity. And that will be Mercer and Chris Cassidy.
Morning, everyone. Good morning, everyone. Hopefully you can hear me. So we have 2 investments this month. I'll try to keep it brief. One is a lower middle market buyout strategy. The other is a more value-oriented buyout strategy. Every year when the RVK asset allocation comes up, one of the big caveats in their presentation is that there's no investor alpha in the assumptions they're making. We're looking for managers in our portfolio that can provide alpha. It's a asset class with a lot of dispersion, and we're looking for managers that can have the potential to be top quartile and have evidence in their history of being able to do that. Also, as we've discussed, as we bring up Invictus here, we are looking for smaller managers that can produce potentially, in this case, venture capital returns if it works. We think it's an important part of portfolio construction, and we'll continue to look for opportunities where we can. The first investment this month is we're recommending a $75 million commitment to Invictus Growth Fund 2. This is a lower middle market buyout fund that backs bootstrap businesses in cloud software, cybersecurity, and financial technology. This fund already has 3 investments in it, so hopefully this fund can provide an opportunity to get out of the J-curve quickly, and that's important as we look to ramp the portfolio with a big increase in commitments over the last 3 years. Pass it along to Richard to discuss their due diligence.
Thank you, Chris. Thank you, Madam Chair. Invictus is a new relationship in the national program. The firm's raising its second fund, and this is one that we've been doing work on for a while as part of our emphasis on smaller managers and diversifying the portfolio with smaller managers in the national program. Invictus was founded in 2019 by John DeLoche and William Nettles, but the founders have 15 years of experience working together. They were previously at Pilot Growth Equity, and they have over 30 years of investment and operational experience. And one of the things that you'll notice about this firm is the amount of resources they have is really impressive for the size of firm that they have. They have created an enterprise growth platform, which includes a proprietary sourcing model that not only helps find companies that they can evaluate to invest in, but also helps their portfolio companies find potential customers. They've also put together a network of experienced professionals to help portfolio companies called the Invictus Guild. Now, the firm's strategy focuses on technology companies, specifically in subsectors like cybersecurity, cloud software, and financial technology. The firm does structure its investments with some downside protection, and post-investment, they're very active in several value creation initiatives, which has resulted in Fund 1's portfolio actually having a strong weighted average revenue growth rate. From a terms perspective, the majority of terms are typical what we would see in the market. On performance, Fund 1 is tracking in the top quartile compared to the benchmark, but the fund is still relatively early, but almost all of the companies are profitable and have strong revenue growth. The founders also shared details of their prior track record that we were able to look at as part of due diligence, and they generated favorable performance there. This investment is somewhat unique, as Chris mentioned, compared to a lot of the other ones that we bring you because they've already started investing, and there's 3 investments in the fund to look at. a cybersecurity company, an enterprise software company, and an AI-driven sales and marketing software solution. And there is expected to be a value increase in those companies, which helps mitigate the J-curve in this situation. So we're recommending an up to 75 million commitment to Invictus Growth Fund 2. And Madam Chair, I'll turn it over to the co-founders of Invictus.
Thank you, Richard and Chris and Madam Chair and the whole council. I'm John Deloche, co-founder and managing partner of Invictus Growth Partners. I'm joined by William Nettles, my co-founder and managing partner, and Zaid Abdul Alim, our partner and head of capital solutions. Invictus is a control-oriented lower middle market software investment firm focused on the verticals of cloud software, cybersecurity, and fintech. And these are areas where William and I have 20 years of history, 2 decades of history as both operators and investors. As Richard mentioned, we've invested together in this strategy for 15 years, and we actually met each other 30 years ago at the CSFB Investment Banking Analyst Training Program. So this morning, I'm going to talk briefly about our 3 drivers of returns. Operational value add is 1, 2, our machine learning platform, and 3, disciplined underwriting through which we have strong downside protection and seek embedded value at entry. So we invest in businesses that are providing mission-critical B2B software that have historically grown as bootstrapped, capital-efficient businesses. We view this as a very attractive area of the market because from a number of exits per year perspective, 70 to 80% of exits are for bootstrap businesses. We aim for a 3 to 5 year hold period during which we accelerate the corporate maturity of every company we invest in through the Invictus Enterprise Growth Platform, which brings best-in-class operating talent, reliable systems for scaling, and then enhances their operations with machine learning. We have 37 professionals, and 25 of them are what we call the Invictus Guild. The Guild is an operating partner network of experts that work around operational excellence for our portfolio companies around 10 different verticals for scaling. Everything from the go-to-market side, like sales, marketing, customer success, through corp dev, biz dev, finance, product, data science, CEO coaches, and other areas for operational excellence. Our machine learning platform is named Diane, and we've been using machine learning since long before ChatGPT made it fashionable to do so. So we have over 5 years of training data now on the platform, and Diane, as well as our outbound calling program, has resulted in 80%, has discovered 80% of our investments that we've closed. We now have 2 additional evolutions of Diane for operational value add for our portfolio companies. One, which helps our portfolio companies accelerate their own sales, and another, which helps them collaborate on new customer introductions. So entry valuation really matters, and we have a disciplined underwriting strategy. We seek strong downside protection with embedded value at entry, and we accomplish this through strong lower entry multiples and creative deal structures, as well as our proprietary sourcing. We're very liquidity focused, and all of our Fund 1 portfolio companies we expect to be in sale processes within 12 to 24 months, which is consistent with that 3 to 5 year hold period mentioned earlier. Fund 2 is a seasoned primary with 3 completed investments and a 4th in exclusivity, so beyond the J-curve risk phase. And we have a programmatic co-investment program that New Mexico would be able to participate with and co-invest alongside us. So thank you very much for the opportunity to present, and we're happy to take any questions.
Sir, did you have anything you wanted to add?
Thank you for this opportunity. John and I have known each other for 30 years, and we've built this strategy to generate strong returns for New Mexico, and we're honored for the opportunity to work with you and to have the privilege of managing assets with you.
Thank you. Council members, any questions? Anyone online? Okay. Unfortunately, I have a few questions, but they already all know this. This is normal. So I wanted to ask you very quickly, how do you have a net IRR of 25%, but it says, quote, fund has not yet completed any full relationships or realizations?
Where's that from?
It's in our portion of the packet, page 3, page 4, and page 1 of the Mercer response.
If I may, it's an unrealized net IRR of 22%.
So the target return is the 25%, correct? And that's your fund 1 or your fund 2?
Fund 1 has an unrealized net return of 22%. We target 5x gross returns with really strong downside protection. It ends up being around 25 to 30% net IRRs.
Okay, thank you. And then Fund 1, I noticed there was quite a bit of cybersecurity, and I think I read something with military information. Is that correct?
Cybersecurity is one of our focus verticals, Madam Chair.
Can you just tell me a little bit more about what that means? Because I'm not an IT.
Yeah, sure. So cybersecurity is sort of like a never-ending arms race where hackers are trying to break into our systems, steal our identities, and do bad things. We're investing in companies that are protecting enterprises from those bad actors. And we really like cybersecurity businesses that allow enterprises to take a proactive approach to protecting themselves.
Okay, thank you. Those were all the questions I had. I'll entertain a motion.
Madam Chair,
Member Tejas.
based on the recommendations of the Council Investment Committee, Advisor Mercer, SIC staff, and general fiduciary oversight from RVK, I move that the State Investment Council approve a commitment of up to $75 million to Invictus Growth Fund 2 LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second. We have a proper motion and a proper second. Is there any other discussion or comments? Seeing none, please call the roll.
Treasurer Laura Montoya,
Yes.
DFA Secretary Wayne Props,
Yes.
Nick Tass,
Yes.
Catherine Allen,
Yes.
John Bingaman,
Yes.
Alan Sanchez,
Yes.
Kurt Summer.
Yes.
That's
Yeah.
7 in the affirmative. Motion passes.
You have a proper motion and we approved it, and we welcome you to the SIC team.
Thank you.
Thank you very much, Madam Chair and the council. We really appreciate it.
Thank you.
Thank you very much. We're very
Safe
honored.
travel. Moving on to our next agenda item. 3E, Private Equity, Atlas Capital Resources 5 LP with Mercer and Mr. Cassidy.
So this is a recommendation to commit up to $125 million to Atlas Capital Resources 5. Atlas is a access-constrained group that focuses on more value-oriented buyouts, which is timely in the current environment that we're getting ourselves into, where groups like this can buy complexity, improve a company, and sell simplicity. And there's no shortage, obviously, of catalysts creating challenges at the moment. Specifically, they purchase control positions in middle market companies undergoing financial or operational stress in targeted industrial sectors where the firm or its operating partners have expertise. Most of the opportunities they pursue are in businesses which have a historical track record of success in a specific market segment, but have lost their way for some reason, usually due to operational or other challenges. Their goal is to return capital quickly by addressing and mitigating these business issues, and then to enhance value pretty quickly after closing an acquisition. They have one of the more unique track records in private equity. They have a very high velocity of capital.
the firm's investment model has enabled a pretty rapid return of a significant percentage of invested capital in most transactions pretty quickly. So you'll see in their track record what makes them unique. Not only have they recycled roughly 35% of their commitments in their first 3 funds, but they've done that in a way that hasn't actually drawn all of the LP's commitments. They've averaged only drawing roughly 62% of commitments from LPs. It's a very capital efficient model, which makes it a great addition to a portfolio. This is a little on the shorter duration side in terms of capital deployment. And if you marry that with some of our other strategies, which tend to have a little longer holding periods, this is a great addition to the portfolio. I'll pass it on to Richard.
Thank you, Madam Chair. So Atlas is another new relationship, fits in the buyout category at the national program. It does focus on controlled buyouts of industrial companies. And just to give you a sense of what industrial means, I mean, there's various sub-industries within industrial, such as automotive components, construction, food processing, metal processing, packaging, power generation, paper, and building materials, which are all focused on by this fund. The firm was founded in 2002 by Andrew Bursky and Tim Fazio, who worked together at 2 previous firms before founding Atlas, and both are still active as managing partners and are joined by a 3rd managing partner, Jacob Hudson, who joined that firm as an associate in 2005 and became managing partner in 2018. In addition to the investment team, a large part of the strategy is the resources that can be brought to portfolio companies. The firm has a functional team that can help focus on various areas such as public affairs, IT implementation, strategic communications, talent management, and real estate. Companies could be sourced from different areas such as corporate carve-outs, failed auctions, or negotiated purchases, and they tend to avoid traditional auctions. From a performance perspective, Atlas has generated favorable absolute and relative returns when compared to the benchmarks, and they've been able to do this with a low loss ratio. And they have been able to generally return capital quicker and have favorable distributions to paid-in capital rankings against the benchmark as well. From a terms perspective, it's similar to what we see with other high-quality private equity firms out there. And just going back to the team for a moment, one thing to note is Atlas has had low turnover over time with its investment team, which seems to be driven by a strong culture focused on developing professionals. And as an example, today we have Michael Scher, one of the partners from Atlas. He joined the firm in 2010 and worked his way up to the partner level. And we see this a lot with the team where partners often have more than a decade of time at Atlas on the team. And this approach was so successful, it's been extended to the development has been extended to portfolio companies as well. And when we were talking to a lot of the portfolio companies, they commented on how valuable this is to developing their own employees as well. So Madam Chair, with that, I'll turn it over to Michael Scher from Atlas for some comments.
Welcome.
Thank you for having me. It's a privilege to be here. I want to begin by thanking Chris and his team for all the work on diligence over the last several months. I also want to thank the council for inviting me out to Santa Fe to speak with you this morning. So today I'm going to talk to you about our firm, our strategy, and of course can answer any questions that you may have. So as was mentioned, the firm was founded in 2002, and our strategy hasn't changed since day one, which is to invest in and operate industrial companies, typically those that are undergoing some form of financial or operational distress. We feel like we have an edge to drive a transformation. So the team today is 78 individuals split between our 2 offices in Greenwich, Connecticut, and London. And of those 78 folks, we have 12 partners. The average tenure of our partner group is 16 years, and our 2 founders have worked together for approximately 3 decades. Our portfolio is comprised today of 22 active platforms operating around the world from several hundred locations. And the lifeblood of Atlas is really our 45,000 plus associates who show up every day and make Atlas run. And, you know, for us, their safety operating in industrial environments is paramount. So from a strategic standpoint, when you invest with us, you're getting our 8 to 12 best ideas over the course of an investment period. So to that end, I thought it'd be helpful to walk you through a bit about how we think
about underwriting and investment selection. And there are really two pillars that come to mind. So the first is deep sector expertise, and the second is a broad transaction toolkit. So for deep sector expertise, our view is that in order to generate truly exceptional investment returns, it's very hard to be a generalist. So we organize ourselves accordingly. Our team on the investment side is dedicated to a little bit more than a handful of industry verticals where we've been investing for many years. And the reason we think that's a sensible approach is we're able to go deeper than others, which allows us to do some things that are very advantageous, such as building out a very robust operating partner and executive network, getting better information flow, which ultimately allows us to make better investment selections. We want our investment team spending time talking to competitors in our industries, suppliers, customers, as opposed to going to conferences to meet other people in the private equity world. The second pillar is a broad transaction toolkit. So while we're very focused on sticking to our knitting in terms of the sectors where we're investing, when we're expressing our investment views, it's important to be nimble and to have a lot of flexibility. So to that end, we have capabilities that we've developed in-house at Atlas to facilitate that, such as a team that's focused on executing very complex corporate carve-outs with large Fortune 500 businesses. We have a team of dedicated debt experts that help us track companies, again, in our core verticals where public or private debt could lead to an interesting control position. And the same goes for the public equity side of the equation, where we have executives on our team that are tracking companies in our core verticals that happen to be public, where we may have an opportunity to establish a toehold position that could ultimately lead to control. Once we own a business, we immediately turn our attention to stabilization and then ultimately transformation. And for us, that really comes down to crafting a value creation plan in partnership with our executive management partners. And the value creation plan is really buttressed by some of the resources that have already been mentioned by the gentleman to my left, including a real estate team, an IT and ERP team, a talent team, a public affairs and government relations team. So I'd be willing to bet if you look at the profile of the 78 individuals that work for Atlas, and you were to compare it to another private equity firm, you would see that our team looks very different, and that's by design because we've built a team that's really curated for the types of opportunities and challenges that we face in our businesses. So in summary, when you add it all up, we're very selective in terms of what makes it through the funnel around investment selection. We run towards complexity and solve problems. We embrace it. And we bring a disciplined and regimented, and importantly, a repeatable and scalable approach to how we transform these businesses. And the result of all of that is we've been fortunate to generate very high money multiple returns on invested capital, as well as high IRRs. And I would note the general partner group is one of the largest investors in our funds. And as we like to say, we eat our own cooking. So I want to thank you for the time and of course, happy to answer any questions that you might have.
Thank you for your presentation. I'll go to council members. Anyone online have any questions, concerns, comments? If not, we'll come to our members in person. I have a couple of questions. I think this is going to be for Richard. I'm looking at the carried interest. I'm looking at the cost. I'm looking at the liability portion. We're taking a lot more risk. I see the fact that you do have better returns, but I don't like the cost and I don't like the liability aspect. Can you give me some answers to that?
Yeah, so when we're looking at investments and we're doing the evaluation, we're looking at a net of fees basis. So we're comparing so if the fund does have more aggressive terms compared to other funds in the market, that'll come out in the net of fees performance analysis and the benchmarking. The benchmarking is a net of fees as well. And, in the private equity industry, sometimes you do have to pay for quality. So high quality managers do have more leverage to charge more aggressive fees. We didn't think these were too out of market from what we typically see. They're slightly above market, the average, but compared to other high quality firms that we see, I mean, they are typical of what we see there.
And is that still negotiable, or is that concrete of what you're asking for from the council today? Or is that something Amy and Evan and you and Michael all work on later?
Yeah, I mean, the economic terms, you know, we try to push during the diligence process. At this point, though, in a firm like Atlas, I mean, it's hard to push too much because they have such a large limited partner base, and we're still relatively small in that limited partner base. But we try to get things through the side letters and other things that are helpful to the SIC through the side letter process.
Okay. Mr. Sher, did you have anything to add?
The only things I would add, I think you'd mentioned higher risk. You know, our loss ratio for our strategy is exceptionally low. We're buying businesses in markets that we understand deeply. And importantly, a lot of the investments we're making are in asset-rich companies. So if you look at our DPI, what you're going to see is we're able to return capital, and it was mentioned earlier from a recycling perspective, early and often. So we do that from a variety of avenues, balance sheet optimization through better management of working capital. Again, making money the old-fashioned way by stabilizing a challenged business. We're doing all of this with very modest leverage. And from a fees perspective, you know, I would note that we have to perform in order to earn the fees that are in your presentation, right? So there are net hurdles from a money multiple perspective, as well as an IRR perspective. And on a personal note, you know, and the same goes for my partners, you know, almost all of our family's net worth is invested in these businesses, and I'd have it no other way. So our skin's in the game right alongside you, and we look forward to the partnership.
Great. And last question, you mentioned the loss ratio. What is considered an average loss ratio with this type of industry?
I don't know the answer to that, but for us, it's sub 1%. So we don't lose money. That's rule number one.
Okay. I did notice, Richard, in your guys' report, the Fund 1 loss ratio comments that you made. Because I don't know if this part's confidential, so just wanted to ask about that. Is that different than what we just said?
Well, we look at the loss ratio in aggregate across multiple funds. I mean, you know, it's not uncommon to see more losses at the beginning as, you know, people are trying to feel out a strategy and the value creation, developing that initiative and how to approach it. But we're looking at overall loss ratio when we look at that ratio.
And so what would be the normal or average percentage with this type of industry?
Typically, we want to look for below 10% loss ratio.
Madam Chair, I have one question.
Yes.
I noticed or heard your comment that you've only drawn on 65% of the limited partnership commitments. Do you anticipate something similar here? And maybe I misunderstood what you said.
Yeah, I think that was a comment that Chris may have made, but I can speak to it. So our strategy allows us to return capital very quickly. And for example, I think in our third fund, the maximum cash out of pocket is around 62, 63%. So that means on a commitment that an LP makes to that fund, it's a point in time snapshot. So at no point in time did you ever have more than 62 or 63% of your commitment outstanding.
Okay.
So there's a netting effect that takes place, but we're still able to invest in the case of that fund and most of our funds, a capital amount in excess of the total commitment, which is a way to get, as Chris mentioned, in our view, exceptional capital velocity while still generating very attractive money multiple returns on invested capital.
Thank you for that answer. That's what I wanted to know.
Sure.
Appreciate it.
Yep, my pleasure.
Thank you. Any other questions? If not, I'll entertain a motion.
Madam Chair,
Member
based
Beaman.
on the Based on the recommendations of the Council Investment Committee, Advisor Mercer, SIC staff, and General Fiduciary Oversight from RVK, I move that the State Investment Council approve a commitment of up to $125 million to Atlas Capital Resources 5 LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
We have a proper motion from Member Bingaman, a proper second from Member Summers. Is there any other discussion? Seeing none, please call the roll.
Treasurer Laura Montoya,
Yes.
DFA Secretary Wayne Probst,
Yes.
Nick Tejas,
Yes.
Catherine Allen,
Yes.
John Bingaman,
Yes.
Alan Sanchez,
Yes.
Kurt Summer.
Yes.
That's 7 in the affirmative, motion passes.
Thank you very much. We look forward to the relationship.
I do as well. Thanks for having me. Have a great day.
You too. Safe travels. Let's go on to our last action item. Under Section 4, Governance Matters, Informational Reports requiring discussion or vote. And we will go to Member Catherine Allen and John Clark.
Thank you very much, Madam Chair. We have had a lot of due diligence, a lot of work. We've done research. We've had multiple meetings to talk about the pay bands and increase in employees for the State Investment Council. Gotten feedback from all of you, I think individually, and I think we're ready to go to discussion here at the council and then a vote. I want to especially call out the Treasurer Laura Montoya. She has asked excellent questions, had us put our feet to the fire to make sure we have all of the answers. And that's helped a lot just in explaining both to the public and to legislators about what we're trying to do. So thank you so much, Laura, for all your diligence on that. And to the rest of the committee to being so involved and to reading what we've been doing and to give feedback to John. So I'm going to turn it over to John to have the discussion and then lead to a vote.
Thank you, Madam Chair, and thank you, Member Allen. I'd like to give a brief overview before we move to discussion and vote. First off, I would like to thank the council members for all of their support and all of the great discussions we've had related to this matter, both during the December strategic planning retreat and in the months since. I'd also like to echo Member Allen in thanking all of the members of the Governance Committee for all of the time you have put in with me over the last few months. I know it's been a significant amount of work. What you see here is the culmination of a lot of discussion and debate, always keeping in mind what is best for the people of New Mexico, and always keeping in mind that the dollars that we invest and the dollars we use for operations belong to New Mexicans. Also, I want to make it clear to everyone that my pay band is not under consideration here. The only direct impact to me, if you approve this today, would be to make my job easier by making it easier for me to retain existing talent and go out and compete nationally for top talent. This is, in my view, the best way to recruit and to staff up the organization. So let's get into the why of this. SIC's assets under management have tripled over the last 10 years and doubled in the last 5. We now oversee a world-class fund, and we are competing with much larger organizations than we used to for talent. The rapid growth of the funds necessitates a rapid growth in staffing, but this has not happened over the last 15 years, leading to the urgent need that we have today. SIC's distributions are already having an incredible impact on the state, and that impact will grow dramatically over time. We are currently funding over a quarter of all K-12 education in the state, and funding 58% of all early childhood programming. By 2039, SIC distributions are projected to surpass oil and gas to become the single largest source of revenue to the general fund. By 2050, SIC distributions are projected to become 1/3 of all general fund revenues, matching all sales taxes and far surpassing all corporate and personal income taxes combined. But we can only achieve these projections if we can manage and invest our funds well, and that means appropriate staffing. As you know, we brought in 2 different groups of national experts to the December retreat to analyze our staffing and compensation, and here are a few key takeaways. If we could please turn to diligent page 345. SIC is severely understaffed with just 14 investment team members managing about $4.1 billion per person, over twice the industry median. To clarify, this is over twice the median of public funds in other states. All public funds that I've talked to have expressed challenges with staffing. So the fact that we are less than half as staffed as they are shows the magnitude of the problem we're facing. The proposed organizational chart you see here provides a clear picture of the situation, with filled positions in medium or dark blue and the additional positions we need to hire in white. Without being staffed up, individual workloads in several years could exceed $7 billion per person, an unmanageable level. This is about security and safety and creating a solid foundation to build on the $2.3 billion we're sending back to the state this year. The Ascension team, led by Dr. Ashby Monk, reported investment in proper staffing could yield us an additional $300 million annually, or more than $3 billion over a decade. Moving to our budget, our FY26 budget includes $7.9 million for personnel. They gave us an increase of $1.5 million from our current $6.4 million budget for personnel, and that's up from the $4.6 million we actually spent last year. At our legislative budget hearing, I talked about our need to staff up, and I showed them the cost of what it would take to be truly competitive and to get to being fully staffed up, and there was incredible support from the committee. It's critical for us to be competitive. SIC currently pays 11% below the median of comparable funds. These are all other public funds, no private groups included in the comparison, and as we grow rapidly, we will begin to leave many of the funds in this peer group behind, competing with increasingly larger funds. The cost of living in Santa Fe is 14% higher than the national average, making competitive pay even more critical. Our two closest peers, the Texas and Alaska Sovereign Wealth Funds, target the 75th percentile for pay, which is roughly the top of these proposed pay bands. And although we need to compete nationally, we did look at what some other government employees in New Mexico are making. You have before you a list of 20 people at UNM alone that make more than $450,000, far exceeding SIC's current top pay bands, and all of these are higher than the median for the highest SIC pay band under consideration today. We could go back to 345 and stay there, please. These pay bands are based on recommendations from the national experts at McLaughlin and Ascension to ensure competitiveness. The table of pay bands is broken down into roles we have today up top in alternating rows of green and white, and roles we don't have but need either today or tomorrow on the bottom in blue. Not every role will be filled immediately, but this also creates a structured career ladder to support long-term growth in alignment with our peers. In addition, we will work to develop an internship program and university partnerships to build local talent pipelines for entry-level positions. Competitive pay and staffing increases are necessary to ensure SIC's continued impact on New Mexico. The investment in personnel will be minuscule compared to the additional returns that SIC can generate with the right team. But we must act urgently and strategically to ensure that we can improve retention and compete at a national level. It is important for the public as well to be aware that by law, all of us here are fiduciaries for these funds that we manage, and we have a legal obligation to act in the best interest of these funds. And I'd like to end with this. SIC deals with many millions every day, but it can be hard sometimes to grasp the enormity of the numbers that we talk about. So here's a good way to think about it. 1 million seconds is a lot of seconds. It would take you about a week and a half to count that many seconds if you did it without breaks. If you started first thing this morning, you'd be done April 6th. But SIC is often dealing with tens or hundreds of millions, and we're talking here about a decision to generate billions in additional returns. So how long would it take to count 1 billion seconds? It would take you more than 31 years. You'd be done November 20th, 2056. We're talking about an investment in staffing in millions to generate billions in additional returns. I can't think of a better investment we could make. Madam Chair, I'm happy to stand for questions.
Council members, we'll start online. Any questions, concerns, comments? Okay, I'll move on to in person. Member Tejas.
Quick question. So we're developing a policy related to our staffing compensation plan for the SIC, is that correct?
Madam Chair and Member Tays, yes, so this would be adopting a comprehensive suite of exempt pay bands for me to use to give me additional flexibility to retain talent and go out and recruit so we can staff up.
And Madam Chair, where would this policy live in terms of the overall policies of SIC?
Madam Chair and Member Tays, this would be a living document that that would exist alongside our other policies, and I would envision coming back to the council regularly with updated information on national competitiveness and with updated information on where we stand related to that, so that this can be updated on an ongoing basis.
And Madam Chair and our State Investment Officer, do we have plans in this compensation schedule to regularly update it with respect to the, inflation rates, things of that nature, which would have to be done on an annual basis?
So Madam Chair and Member Tays, my intent is every year to get updated information on national pay comparisons. And by getting that updated information each year, that would take into account both market changes as well as general inflation levels, yes.
Yeah. And Madam Chair, I would ask that we do that. I think that it would be really advantageous for us to consider this maybe on an annual basis. Perhaps the council could approve this annually, and then assure that we are going to keep up with the, respective inflation rates related to compensation. You end up just getting behind if you're not able to do that. So with that, that's all of my questions.
So just to clarify Member Teas's perspective, the pay bands that you sent to us, those are confidential, I'm assuming?
So Madam Chair and members, the pay bands will not be confidential. The only thing that's confidential is the McLaughlin competitive pay data, because that is confidential to them. But the public will get a version of this packet that has the pay bands listed. Our pay bands, I believe, should be public, and I don't think there's any way that they couldn't be made public. Just as the pay bands for all other agencies are public, these will be public too.
Sorry, to clarify, what I'm looking at right now is confidential still, correct?
Correct, just the McLaughlin data piece, yes.
And what you're proposing today is looking at this at the column N with the 50th percentile. That's what you're asking us to approve for the pay bands?
So Madam Chair and members, thank you so much for the clarification. I'm asking you to approve the middle of the chart, the proposed pay bands, which includes the minimum, midpoint, and maximum.
Okay. Member Summers, you have a question?
Yes, Madam Chair. First of all, I'd like to thank Catherine Allen for her leadership on the Governance Committee. Thank you for pushing this through. It was rather quick, and I'd like to also thank you, Madam Treasurer, for all the questions you posed and the concerns you raised from a public perspective. I think they're very, very good questions, very well addressed, and I think that, John, you addressed them well. I think you were to be commended for the speed with which you addressed this problem, which we saw at the strategic planning meeting. Thank you. I wholly support this initiative.
So I do have a couple questions and comments for clarification. Annually, to Member Teas's point, are we still going to do the legislative increases where you decide on on exempt positions if they receive the executive or legislative increase?
Madam Chair, my intent there would be to follow suit with what we've done in every prior year, which is those legislative increases apply across the board to all employees, executive and classified. I would intend, if the legislature approves future increases, for those again to apply.
And I was going to say, Mr. Chairman, Mr. Clark, when do you expect for this to go into effect?
Madam Chair, so we just came out of the legislative session. We do now know what budget we're going to have for the 200 personnel category. I need a final meeting with our CFO, Brent Shipp, and I think we could implement these really quickly. My hope is potentially to be able to implement these in April. Just to let everyone know, anyone currently in a classified position would have the option to move into this exempt position. There are additional protections for classified positions that we can't force employees to give up. So we will schedule a staff meeting and go over with all of the employees what that means going from classified to exempt, and every person will have the option to do so. If they would prefer to remain in a classified position, then they will have the option to do that.
Mr. Clark, the budget that was just approved by the legislature starts July 1st. So do you have funding right now for this fiscal year to do increases?
Madam Treasurer, yes, we have some funding in there to do increases this year.
And would you be able to do those increases and be compensated for the legislative increase as well, based on the new dollars that, because it is significant money on the shift. Do you have enough going into the next fiscal year with that dollar amount?
Yes, Madam Treasurer, we do. And also, I would note that as we are not a general fund agency, we are not impacted by the changes made to budget adjustment authority for general fund agencies coming out of this legislative session. So we do have a significant ability to move money around or some ability to increase our entire budget if we need to from our funds as well, if that's required.
Keep on using Mr. Chairman. Mr. Clark, the percentage of the increase that you received for the 200 category, did that include the increases that you were proposing, or are you going to have to pull from a bar from another category?
Madam Chair, the initial increases would fit into that. And then if we are successful at hiring as quickly as I hope we are, we will need to do budget adjustments to go back and increase the budget for additional hiring.
And last question, Mr. Clark, we did mention during one of our governance meetings to add in some of the compensation pay for other folks in New Mexico, including nurses and doctors and coaches. Did you want to go into any of that at all for the record, or do you feel good about not putting it out there? Because I thought that was pretty shocking.
Sure. So, Madam Chair, so we do note in the memo that is also part of the public document package, the 20 different positions at UNM that includes professors, coaches, medical personnel who all make over $450,000, which again is over the midpoint of any of the pay bands under consideration here. The memo also notes some other positions in state government that currently pay more than virtually all of our positions at SIC. This really isn't an issue of SIC pay getting elevated above levels not seen before in New Mexico. It's an issue of correcting a historical issue where pay levels at SIC were kept artificially low compared to our industry, and also not kept, I would say, in alignment with key decision makers in other positions of government in New Mexico.
Can you put that document up? The salaries? No, the salaries of nurse practitioners, coaches, just so that if anyone is seeing online or if somebody reviews this video later, these are the pays for example, a psychiatric nurse makes $283,000. A basketball coach made $1.2 million. Football coach makes $1.15 million. Emergency medicine makes $738,000. The reason why I thought that this was really important is to put it into perspective. What Mr. Clark mentioned was each individual director is managing $4 billion. And though we do have some outside contractors that assist us with things, the in-house needs to be able to have enough hours in the day to audit, to do due diligence, to be able to manage the amount of money that is coming in and also what we already have. I think the second aspect is that the amount of money we lose far exceeds the amount of money we need to get back on par. And my understanding is that we have also not had any increases to fluctuate from what the amount of money and magnitude of money that has come into SIC over the last 10 years. And so this is a really good correction. And I want to thank Member Ellen and the governance committee, because I was not on board at first until we got all of the paperwork, all of the data, all of the research. We did the compensation study, we did the retreat, we did our due diligence. Member Ellen looked at other of her boards as well. Member Summers put in all the legal aspects of this conversation. So I just want the public to know that everyone did a really good effort in making this done right, and it took us a lot longer, but I think we all feel a lot more comfortable with where we're at in getting this done, and it being a really good structure, not only for SIC and New Mexico and other sovereign wealth funds, but also our pension funds and even my office. So I'm very grateful for you all being patient with me to get all the extra in there. I'll take all of it as compliments. If there's nothing else, I'll entertain a motion.
Kathy? Based on the recommendations of Council Governance Committee and the State Investment Officer, I move that the State Investment Council approve the proposed exempt pay band adjustments and structure relative to all SIC employees other than State Investment Officer as memorialized for and discussed by the council at today's meeting.
Second.
We have member Kurt Summers making the proper motion, member Ellen seconding. Any other discussion or comment? Please call the roll.
Treasurer Laura Montoya.
Yes.
DFA Secretary Wayne Probst.
Yes.
Nick Tejas.
Yes.
Catherine Allen.
Yes.
John Bingaman.
Yes.
Alan Sanchez.
Yes.
Kurt Summer.
Yes.
That's 7 in the affirmative. Motion passes.
Wonderful. Thank you for all the legwork on that, and to the entire SIC. Know that your council unanimously supports you. And I would say also, for those that don't know, this council selected John in one big effort of also knowing his expertise on being able to fill vacancies, diversify the population of employees, and to make sure that they're being paid appropriately. So for all of the team that worked on that, I want to thank you guys. So let's move on to the next agenda item. 5, finance matters. CFO Ship.
Madam Chair, I have no comments today.
Closing matters. Is there any old or new business?
Madam Chair, as new business, I would suggest that we schedule a review of Mr. Clark's performance for the last year as part of a salary reconsideration for him separately with the governance committee.
That's next on our agenda for the governance committee, so.
Member Ellen, we always keep you busy.
Thank you.
Well, I am just so grateful to all of you on the committee and to John and his staff for putting this together. This is amazing that we got it done so quickly, and it's amazing, and it's, you know, credit to the staff and credit to you, Treasurer, for asking all the right questions so that we made sure we had all our I's dotted and T's crossed. So I think this is going to help us to really attract and continue to keep the talent that we have. And that's what we're trying to do. So thank you all. And thanks the council for voting to support this.
And Madam Chair and members, I also just want to give you enormous thanks for my part and on behalf of the staff for what you voted on today. Thank you very much.
Thank you. Hopefully you guys all stay in New Mexico because we want you. If there's no other old or new business, the next SIC meeting is Tuesday, April 22nd at 9 a.m. The location is to be determined. Do we have any public comment?
Madam Chair, we do not.
Well, thank you all for your patience with me chairing today on behalf of our chair. Have a wonderful week. Meeting adjourned.
Thank you.